Ladies and gentlemen, I'd like to invite Ms. Zahra Dahmani, Director of Taxpayer Service Department at the Federal Tax Authority, to deliver her welcome speech. Please welcome her to the stage.
Distinguished guests, ladies and gentlemen, good morning. As part of the Federal Tax Authority strategy to provide a supportive tax environment for voluntary compliance, and as a Director of Taxpayer Services, my team's mandate is to not only ensure every businesses and individuals understand their corporate tax obligations, but they have also the tools to meet the compliance. We recognize that compliance is not just about rules. It's about providing clarity, simplifying processes, and actively supporting your journey under the UAE corporate tax system. Reducing administrative burden is a core pillar of our work. Therefore, initiatives like small business relief, as well as streamlined registration for natural person and all reflect this commitment. Through our Imara Tax platform, we have automated processes to save your time, from registration to filing, while ensuring to maintain transparency at every step. Taxpayer Services is not just reactive, we are proactive. Webinars like today, along with the guides and frequently asked questions, are designed to answer questions before they become challenges. And as you may all know, SMEs are an essential part of our economy. Through the Small Businesses Relief and dedicated helplines, we ensure small businesses can focus on growth, while we bring them all the facilitations and support that they might need. On the other hand, for free zones, our team works closely with entities to clarify qualifying conditions, because compliance should never hinder competitiveness. In short, our goal is to maintain disputes or misunderstanding through clarity. This means providing detailed explanation for all tax regulations, pre-approval mechanisms, and published guidelines, so we can help you meet all expectations upfront. In the end, our success is measured by yours, whether you are multinational businesses or individual, navigating our economic ecosystem. Our message is clear. We are here to help, not just to enforce. Thank you all, and hope you have a very good session today. Thank you.
Thank you, Ms. Zahra Dahmani, for your insightful words. And now, ladies and gentlemen, I'm pleased to introduce our expert panel who will cover the key elements of the corporate tax law. Please welcome Rida Hamzawi, Senior Tax Policy Expert, Anurendra Sangrajka, Tax Policy Expert, Suraj Perm, Senior Tax Policy Specialist, Zubair Chowdhury, Tax Policy Expert, and Shabtma Biswas, Senior Tax Policy Specialist, where they will present to us the general principles on taxation of corporations and businesses for determination of taxable income. Please welcome them to the stage.
Thank you very much, Ruda. Thank you also to our colleagues in Taxpayer Services in FTA for facilitating this workshop. Ladies and gentlemen, Your Excellencies, thank you very much for dedicating the time to attend this session about the determination of taxable income, which is kind of timely planned before the deadline to file the corporate tax returns, and also which is timely planned because of the initiative that was introduced by the FTA in coordination with MOF in order to waive the late registration penalties. And we will talk about the condition of this waiver and how it would apply and how you can benefit from this initiative. If we have a look very quickly at the agenda of this session, we will talk to you about the key pillars of the corporate tax law in the UAE. We will talk also about taxation of natural person and what are the types of income that are excluded for the sake of determining the tax liability or determining whether natural person is subject to tax or not. We will talk about specific reliefs that are available in respect of, determination of taxable income, mainly the small business relief. We will talk about qualifying free zone person and the requirement, the condition to be considered as a qualifying free zone person and benefit from a 0% corporate tax rate on your qualifying income. We will talk finally about the determination of taxable income, so the election on a realization basis, deductible, non-deductible expenses, exempt income. So we talk about mainly the participation exemption under Article 22, also Article 23, the foreign PE exemption under Article 24 of the corporate tax law, the transitional reliefs, the qualifying group relief, and the business restructuring relief under Article 26 and 27 of the corporate tax law. We'll talk about tax losses and also foreign tax credit. The last part will be dealing with compliance and, after determining taxable income, what are the supporting documentation, the documentation records that needs to be maintained by the taxpayer. And at the end, we will have a question and answer session that is based on the questions that have been submitted for this session and also for previous sessions. So if we look at the corporate tax timelines, of course, the corporate tax law was announced in January 2022. There was a public consultation. Then the law was issued in October 2022. The registration campaign was open in May 2023. And then, of course, for most of taxpayer, their first tax period will be the first financial year starting on or after 1st of June 2023. So for most corporate tax payer, the first tax period will be from January till December 2024. And their filing deadline will be by end of September 2025 for their first tax period. Also, I think it's important to mention that the FTA launched an initiative in coordination with MOF, and this was approved by the Cabinet, to waive the late registration penalty. And the main condition to waive the late registration penalty is to file your tax return within 7 months from the end of your first tax period. Or if you are an exempt person, to file your annual declaration within 7 months from the end of your financial year. So if you file within 7 months and not 9 months as required by Article 53 of the city law, you will be able to benefit from a late registration penalty. And this will be applicable also for a corporate taxpayer who did not register yet. So even if you did not register yet up to this moment, if you apply for registration, submit your application for registration, of course, because you are late, you will get, if you are late, you will get a late registration penalty. But then if you file within 7 months from the end of your first tax period, you will be able to get a waiver of this penalty. Or if you paid already this penalty, you'll be able to get a refund. I think it's important to mention this initiative because I think it's part of the flexibility and part of the enhancement of compliance of taxpayer. If we look at the corporate tax framework and the other resources available for taxpayer, of course, we have the corporate tax law, the federal decree law issued by the President of the UAE. We have a certain number of cabinet decisions which are issued by the cabinet. The city law also, it refers to a certain number of ministerial decisions that are issued by the Minister of Finance. And then we have FTA decisions that are issued by the Chairman of the Board of Directors of the Federal Tax Authority. The additional resources that are available are, of course, FTA guides. Up to now, the FTA published more than 24 guides in English and around 18 or 19 guides in Arabic. The last guide that was published is the guide on family foundation. Also, FTA published a certain number of public clarification. Up to now, 5 public clarifications have been released by the FTA, and all of these are available on the FTA website, whether in respect of the legal framework or also with respect of the additional resources, which are the guides and the public clarifications. One of the key definitions in the corporate tax law is who is a taxable person, and a taxable person is either a resident person or a non-resident person. A resident person could be either a juridical person or a natural person. The same for non-resident person. It could be either a juridical person or a natural person. And the distinction is extremely important because of the registration timelines, because also of the way how you determine the tax liability, whether it is a resident person or a non-resident person. So what are the definition and how to define a resident person that is a juridical person? Basically, a resident person is a legal person that meets one of the following definitions. Either it should be incorporated, established, or recognized under the UAE laws, or it is incorporated, established, or recognized in a foreign jurisdiction under the law of a foreign jurisdiction, but is effectively managed and controlled in the UAE. How to determine whether a foreign company is effectively managed and controlled in the UAE? Basically, it depends on facts and circumstances, but mostly we need to look at where the key strategic and managerial decisions are taken, and if those key strategic and managerial decisions are taken in the UAE on a regular basis, the entity will be very likely considered to be effectively managed and controlled in the UAE. So if we take, for example, a company that is incorporated in Bahrain or a company incorporated in Saudi Arabia, the company, all the board members are resident in the UAE, all the board meetings are held in the UAE, the key managerial and strategic decisions are prepared and taken in the UAE over a tax period, then very likely this entity will be considered as effectively managed and controlled in the UAE, and then it will be required to register, and it will be considered as a resident person in the UAE, despite the fact that it is incorporated in a foreign jurisdiction. Of course, the entity, because it is incorporated in a foreign jurisdiction, it might be also considered under the law of the foreign jurisdiction, the corporate tax legislation of the foreign jurisdiction, as resident in the foreign jurisdiction. In that case, we are in a situation of a dual resident. How to solve the dual resident situation is based on the any applicable double taxation agreement between the UAE and the foreign jurisdiction. And we have what we refer to under double taxation agreement as tiebreaker rules, which is in Article 4, the article on residence in the DTAs, and then usually, these articles, they provide for what we call a dividing line or tiebreaker rule, and it refers mainly to place of effective management or any other criteria such as place of the head office or the place basically is to be determined based on a mutual agreement procedure between both tax authorities, the UAE authority, competent authority, and the foreign competent authority. So this is how basically the definition of residence is defined under the corporate tax law, under Article 11 of the corporate tax law. If you are a resident person for corporate tax purposes, you will be subject to tax on your worldwide income, and basically worldwide income is income derived from UAE sources and income derived from foreign sources. If your foreign source income has been subject to tax in the foreign jurisdiction by way, for example, of withholding tax, then if that income also is subject to tax in the UAE, is subject to corporate tax, then you will be able to get a double taxation relief based on Article 47 of the corporate tax law in the form of a foreign tax credit. And my colleagues, Anu and Suraj, they will talk about the requirement and how the foreign tax credit article is applicable. Now, we talked about resident. What about non-resident? So according to the corporate tax law, a person who is not a resident person and meet one of the following situations or position will be considered as a non-resident person for corporate tax purposes. So basically, the first condition is that the person has what we refer to as a permanent establishment in the UAE. And the second situation is when we have a non-resident person deriving state source income. And the third instance is where the non-resident person has immovable property from which it derives income in the UAE. And this is only applicable to non-resident juridical person. So this third bullet point, it applies only for non-resident juridical person. But what about the PE definition? So the PE concept is defined under Article 14 of the corporate tax law, and we have mainly two types of permanent establishment: the fixed place PE and the dependent agent PE. The fixed place PE is basically a place through which a non-resident is carrying on core business activities, for a certain time. Usually we refer to this time by 6 months. So if it's a construction activity, the law defines clearly at Article 14 refer to a 6 months. If it's a service activity or any other activity, the timeline is also 6 months, but this has been defined in the guide on non-resident person that was published by the FTA in 2023. So the first type of permanent establishment is a fixed place permanent establishment. And it means that the non-resident is conducting core business activity in the UAE for a certain period of time, usually at least 6 months. And then if this is met, the person will be considered to have a permanent establishment, and he will be considered as a non-resident person having a PE, and is required to register under for the corporate tax purposes as per the timeline that are specified by FTA decision number 3 of 2024. The second instance where a non-resident person will have a PE is the dependent agent permanent establishment. A dependent agent is a person that habitually concludes or negotiates contracts on behalf of a non-resident person. So you have a person in the UAE that is representing a foreign company, and he approached potential clients, he showed them the products, he provide them with all the elements related to the product, the quality. He also prepared the contract, prepare all the elements of the contract, the pricing, guarantee, terms of payment, and then if he concludes the contracts or negotiate the main element of the contract without material modification by the non-resident person that he represents, then in that case, very likely that person will create a dependent agent permanent establishment for the non-resident person. And what does that mean? It means that all the sales that are derived by that dependent agent, they will be attributable to that permanent establishment that is created by the non-resident person. So if, for example, you have a dependent agent that contributed to derive 10 millions of sales, he will get 5% commission based on his contract with the foreign entity. Then, of course, the commission, the fees that he gets as a commission, 500,000, they will be considered as business income. But if that dependent agent creates a permanent establishment, then in that case, all the sales that are derived through that dependent agent, they will be attributable to the permanent establishment that is created for the non-resident person. And then we attribute the 10 million of sales, we attribute them to that dependent agent in the UAE. The second situation where you have a non-resident person that is deriving state source income. Of course, state source income is defined under Article 13 of the Corporate Tax Law, and currently it is subject to withholding tax at the rate of 0%. The third situation where the non-resident person is considered to be a taxable person is for non-resident juridical persons, so non-resident companies, non-resident legal person, if they have a movable property in the UAE through which they derive income. So if a foreign company owns a property in the UAE, a land or a building, and they are renting this property and they get rental income, then in that case, the non-resident juridical person, the non-resident company, will be considered to have what we refer to as a nexus in the UAE, and the nexus has been defined by Cabinet Decision 56 of 2023, which has been also updated or replaced by Cabinet Decision 35 of 2025. And then in that case, the nexus will trigger a position of a non-resident person for the foreign entity, and they will need to apply for registration and to file a tax return for the income derived through that nexus. What is the corporate tax base? So in the case of a permanent establishment, it's all the income that is attributable to the permanent establishment. So basically we attribute gross income, sales, and we attribute also expenses to that permanent establishment as for any resident company. We also, with respect to nexus, it's the income arising from the movable property. Mainly it is a rental income, and the rental income in that case will be attributable to the nexus, and the non-resident juridical person will need to pay corporate tax on that income. And for state source income that is not attributable to a permanent establishment in the UAE, as we said, currently the withholding tax on state source income is 0% based on Article 45 of the Corporate Tax Law. So this is mainly a summary of definition of a non-resident person for corporate tax purposes. What are the corporate tax rate? So basically, a natural person is subject to tax on his taxable income up to exceeding 375,000 dirham. What is taxable income up to 375,000 dirham is eligible for 0%. For resident person, the taxable income also up to 375,000 dirham is also eligible for 0%, and then what exceeds the 375,000 dirham is subject to tax at the rate of 9%. The same applies for non-resident person with a PE in the UAE and also with the nexus in the UAE. And then for non-resident person with only UAE state source income, they are subject to tax at the rate of 0%. And currently the withholding tax rate on state source income is 0%, as I mentioned, based on Article 45 of the corporate tax law. I wanted to mention also that there is another rate that is applicable, of course, for qualifying free zone persons. So qualifying free zone person, they will be subject to, if they meet the condition, as it will be explained by my colleague Shabtama, if they meet the relevant conditions under the city law and also Cabinet Decision 100 and Ministerial Decision 265, they will be eligible for a 0% corporate tax rate on their qualifying income. What is non-qualifying income will be subject to tax at the rate of 9%. So they will not get the exempt portion, they will not get the 0% on income up to 375,100 UAE dirham. So for qualifying free zone person, if they meet the relevant condition, they will get 0% on their taxable income. That is a qualifying income, and qualifying income is clearly defined under the city law, and also it has been explained under the free zone guide that was published in May 2024. And then all what is non-qualifying income will be subject to tax at the rate of 9%. This is the key difference in terms of corporate tax rate between those person and qualifying free zone person. Now, I think few elements about the accounting standards. I think for corporate tax purposes, a taxable person is required to apply the IFRS. As an exception, also, it is possible to apply IFRS for small and medium-sized entities if you generate revenue of less than 50 million dirham. Also, you are required to maintain audited financial statement if you are a qualifying free zone person, or if you are a taxable person with revenue exceeding 50 million UAE dirham. So if you have more than 50 million UAE dirham, you need to prepare and maintain audited financial statement. If you are a qualifying free zone person, irrespective of the level of your revenues, whether above or less than 50 million UAE dirham, you need to maintain, and prepare audited financial statement, and it's a requirement in order to be considered as a qualifying free zone person. The accounting principles in respect of which, or based on which the financial statement need to be prepared are the accrual basis of accounting. As an exception, it is possible for a taxable person to use the cash basis of accounting when prepare financial statement if it generates revenues less than 3 million or less, or in certain exceptional circumstances as defined by the FTA. A very important element that was clarified by Ministerial Decision 84 of 2025 is that for non-resident person, for the sake of determining the 50 million threshold, so in order to see whether you need to prepare and maintain audited financial statement, the revenues that are derived through the permanent establishment or the nexus, only those revenue they need to be taken into account. So if you are a non-resident company with a permanent establishment in the UAE, in order to know whether your permanent establishment need to prepare audited financial statement or not, the 50 million threshold, it needs to be considered only at the level of the permanent establishment in the UAE and not based on the level of the revenue of the non-resident entity in its entirety. And this has been clarified in Ministerial Decision 84, I think in Article 2 of Ministerial Decision 84 of 2025. Finally, I think we will talk about this when we discuss the accounting aspect of determination of taxable income. You can elect for realization basis under Article 23 of the corporate tax law, and in that respect, you recognize the transfer or the sale of your assets only when this transfer is realized. And this is, I think, also it's a very good flexibility in terms of determining your taxable income, because it provides relief in terms of cash, in terms of CT liability. In the next session, my colleague Zubair will talk to you about the natural person aspects, so all the rules that are related to determination of taxable income for a natural person and when a natural person is considered as subject to tax in the UAE. Thank you.
Thank you very much, Rida. So in the next part of this presentation, we're going to be looking at natural persons specifically and some provisions which are important for considering taxable income and specifically excluded income when you are determining taxable income for a natural person. So a natural person is an individual and not a juridical person, as has been covered by Rida just now. So when are natural persons subject to tax? When are they subject to corporate tax in the UAE? Well, the requirement is outlined by Article 11 of the Corporate Tax Law when they are conducting business or business activity in the UAE. There is also a threshold which is provided by Cabinet Decision 49, and that states when the total turnover derived from those activities being the business or business activities, exceed 1 million dirhams in a Gregorian calendar year. So that will be January to December for any and each year. Each will be assessed separately. Then that natural person will have to, they will be a taxable person subject to corporate tax, and they will have to determine their taxable income. So what is turnover? And why is turnover important for natural persons? Well, when you're calculating turnover, you need to exclude certain aspects of income. And we'll come into those three categories in just a moment. But let's look at the corporate tax base. So when this threshold has been exceeded, when the natural person has calculated their turnover and it crosses the 1 million and exceeds the 1 million threshold, what are they taxed on? So, first of all, it will be business that they conduct in the UAE, and it will also be income that they receive from overseas if it's in relation to the business that they conduct in the UAE. So even if the source is outside of the UAE, if it's in relation to the activities that they're conducting in the UAE, that will be captured and that will be part of their corporate tax base for that individual, for that natural person. So the exclusions, and these exclusions are very important for determining taxable income because they are completely excluded. So, and the exclusion effectively means both the income and if there's any expenditure which may fall in line with these activities, they are also excluded. So there are three categories: salaries and wages, i.e. employment. We have personal investment income, and we have real estate investment income. Now, you will be familiar with these from Cabinet Decision 49, which outlines and specifies these, and we also have the Natural Person Guide, which provides guidance and brings to life the Cabinet Decision. At the bottom of the slide, you can see the point about where a natural person resides. Now, for the purposes of the UAE Corporate Tax Law, if a natural person is conducting business in the UAE, business or business activities in the UAE, they are considered a resident person that is a taxable person. And so the provisions related to both those points will be applicable to such natural persons. So let's turn to the exclusions next. First, we have wage. And these three, as I just mentioned, are in Cabinet Decision 49. So a wage is anything which is given to an employee in consideration for the services as part of their employment contract. Now that can be monetary, but it could also be any benefits in kind. So if any remuneration is received as part of an employment contract, that will also be excluded and covered under wage. So that can be an annual, monthly, daily, hourly rate. Anything which is covered under an employment contract will be excluded from considering the turnover threshold. And also allowances, bonuses, anything which forms part of the employment contract. Next, we have personal investment income. So this is any investment income that is undertaken by the natural person on their personal account. Now, there's 2 points to note, 2 important points to note. How do you assess that? And Cabinet Decision 49 brings this to life and says, effectively, you neither have nor require a license. And that's effectively the test for considering whether something is personal investment income or it is not personal investment income, in which case it would be considered for your turnover and it would not be excluded. So, license or requiring a license, simply the fact that you do not hold or do not have a license would not make a difference. If you are undertaking, as a natural person, if they are undertaking an activity which requires a license, then that will not be personal investment income. Also, any of the activities that the natural person undertakes should not be considered a commercial business within the commercial transactions law. We'll come into this in just a moment with an example. Moving now to real estate investment income. We also have a guide dedicated to this for natural persons and real estate investment income, which covers an array of examples in different situations. So a very useful resource. Real estate investment income. So if we're looking at this from the point of view of what is excluded, it's any investment activity which is conducted by a natural person that's directly or indirectly, which is the sale, leasing, subleasing, and renting of land or real estate. And it's the same point here. There is no license held and it doesn't require a license to conduct that activity. So if someone doesn't have a license, but they require a license, it doesn't fall within this exclusion. Equally, if someone is holding a license for that activity, it's not excluded under Cabinet Decision 49. So the key test for real estate investment income is, again, a license existing or the requirement to have a license, even if a license is not held. So we'll turn to a few examples which put these into practice. So the first we'll do is wage. And we have here a natural person working for a company based in the UAE. They hold a senior management position and they have an operational role. They have a crucial role in day-to-day operations, and they are also on the board of directors. They're a member of the board, and so for their managerial role, for their operational role, they receive a market rate salary, and also they receive separate remuneration for their role on the board. Now, the salary they receive, the market rate salary that they receive from the company, will be considered as wage. That's provided under the employment contract, and therefore it would be excluded. So if that individual, if that natural person is conducting any business or business activities in the UAE, they would not consider any amount that they receive from this employment contract when they determine their 1 million threshold. Now, the remuneration that they receive for their role on the board would also be considered as wage in this situation. As an employee's salary, they are undertaking this activity as an employee of the company, and therefore this will also be considered as wage and therefore be excluded. So everything that this natural person is gaining or being paid for both of these roles would be excluded. And obviously, if they do not have any other business or business activity, they would not be within the scope of corporate tax. So even if these amounts were 2 or 3 million and they were paid a lot over the Gregorian calendar year, it's excluded as it's covered by the exclusion under Cabinet Decision 49, and therefore these amounts would not need to be considered. Turning now to personal investment income. So we have a natural person here again, and two scenarios. So scenario one is the first half, and scenario two is the second half and the future situation. So we have a natural person who uses their personal savings that they have to invest in listed securities, and they earn income from their investment. The natural person does not require a license, and neither do they hold a license for those activities. Therefore, that activity fits squarely within the definition of personal investment income. Again, the commercial transactions law does not apply to this specific activity. Therefore, any gain that they have, any income that they receive, is excluded from when considering their turnover threshold. And just a reminder that these exclusions are not for calculating your taxable income, it's for considering whether you meet the turnover threshold. The turnover threshold test, once that is met, that's when you would then consider your taxable income and determine your taxable income. This is the precursor to that. Turning now to scenario two, we have a natural person. Same natural person has expanded their activities. And their activities now, they require a license. They previously did not, but now that they require a license, then they do not fall within the exclusion. And the important point to note here is that all of the amounts that they receive from this activity will be covered, would not be covered, under the exclusion. So even if they had a certain portion, and then after expanding their activities, they invested more and they required a license, all of their activities, as covered by the license, would now fall out of scope of the exclusion. So they would not be excluded from determining the turnover. Now turning to real estate. Again, we have a natural person based in the UAE, and they own several properties located in Dubai, and they rent them out for 1.2 million dirhams per Gregorian calendar year. That natural person has also just sold their own home, a residential apartment, and the amount that they received was 2.5 million dirhams, and they made a profit on the sale. Now, the rented properties are under long-term tenancy, so they are under the Ijari contract, and that is not considered a license. Given that it's not considered a license, that would be considered as real estate investment income and therefore excluded from the turnover figure. Also, with respect to the sale of their own property, it would not require a license. They neither have a license nor would it require a license, and therefore it would not be subject to corporate tax because it would fall within the exclusion provided by Cabinet Decision 49, namely real estate investment income. So we've summarized the exclusions for natural persons with respect to determining their turnover threshold, and of course, once they have determined their threshold, determined their turnover, if it does exceed the 1 million dirham threshold, then they would need to calculate and determine their taxable income. However, there is a relief, and this does not just apply to natural persons, it also applies to juridical persons. So as Rida mentioned before, when juridical persons are taxable persons, when we've just covered now, when natural persons are taxable persons, we have small business relief. So what is small business relief? Why does it exist? Why do we have it in the corporate tax law? It's in the corporate tax law as Article 21. We also have Ministerial Decision 73 of 2023. And it exists to support small businesses. Obviously, corporate tax is new to the UAE. It's a new regime. And, for the first few years, it's a very big change for small businesses. And that's why we have small business relief. It effectively eases the transition period into corporate tax. What does small business relief mean? If small business relief applies, and we'll come on to the conditions in just a moment, what does it actually mean for the taxpayer at the end of the day? If it is elected for, it means any eligible persons will be treated as not having any taxable income during the relief period. Therefore, the taxable income will be deemed to be nil. One of the consequences of small business relief is that other exemptions and reliefs and deductions are not available. They're not applicable. So some of the reliefs and deductions that we will talk about today, small business relief is being elected for, they won't apply. So the key benefits, of course, importantly for this session, if small business relief is being elected for, there is no obligation, there's no requirement to calculate taxable income. It also means simplified administrative reliefs, in the sense that there is a simplified tax return if you're claiming small business relief, and also simplified record-keeping requirements. And of course, the most important part of the relief is there's no requirement to pay corporate tax during the relief period. When is the relief made? The election made? The election for the relief is made at the time of the tax return. So as Rida mentioned, 9 months to file your tax return. Of course, there's the initiative with the waiver, which changes that. But at the time of filing of the tax return, that's when the small business relief can be elected for. It does not need to be done before. It's at the time of filing. So let's turn to conditions next. Who can elect? So this applies to resident persons, and as I mentioned earlier, both natural persons and juridical persons can benefit from small business relief. And that also includes a free zone person. Just note there, it's a free zone person, not a qualifying free zone person. And that means if there is a free zone person who's based in a free zone, there are further consequences, and my colleague Chaptamal will come on to that shortly. But if you are a free zone person, that does not preclude you from applying or electing for the small business relief. What are the conditions? So an election has to be made for each tax period. It's not an election that's made once and it sticks. It needs to be made in each applicable tax period. Now, the important threshold here is 3 million dirhams. So the taxable persons, so the natural person or juridical person, revenue threshold for that specific tax period shall not exceed 3 million dirhams. It's also previous tax periods. So the 3 million dirham threshold not only applies to the current year that you're looking at, but also the previous tax periods. And when I refer to tax periods, I'm not referring to financial years. So irrespective of income pre-CT or prior to the CT regime or prior to the first tax period is not considered here. It's the first tax period, and then when you're in your second tax period, any of your current and your previous tax periods. So once you have exceeded that threshold, you can no longer apply for small business relief. When is the relief available? It's available for any tax period starting on or after the 1st of June 2023 and ending on or before the 31st of December 2026. And that's provided by Ministerial Decision 73 of 2023. So just to reiterate on the conditions, the most important point is that the revenue shall not exceed 3 million dirhams. That's for the current year and previous years. each of the tax periods. So who cannot elect? I just mentioned free zone persons can. A qualifying free zone person cannot. So if you're in the free zone regime, if you're utilizing the free zone regime that Rida mentioned earlier, would be subject to 0%, potentially a 9% rate. Also, small business relief would not be applicable and not be available to you. Also, if you were a member of a multinational group, so that means a consolidated group revenue of 3.15 billion dirhams, then equally you're most likely not a small business, and the small business relief will not be applicable in that situation. Also, we have an anti-fragmentation rule, so persons who artificially separate their business into more than one entity to lower their threshold, lower their revenue to not exceed the threshold, it won't be applicable. That's provided for in the ministerial decision. So if there is any attempt at fragmenting business activities or separating them into multiple entities purely to utilize small business relief, then the relief will not be available in these situations. So as I mentioned in the last slide, the most important point for small business relief is considering revenue. So we're just going to look at a couple of slides on how you get to your revenue figure and how we would measure your revenue in considering the threshold of the 3 million dirhams. So the revenue is the gross amount of income that which is calculated for each tax period, and that's as per the applicable accounting standards. So that's IFRS or IFRS for SMEs. And of course, there is the option to adopt the cash basis of accounting that was mentioned just now by Rida. So that can also be used to consider your revenue figure. Now, transfer pricing documentation is not required if you are eligible and elect for small business relief. However, the revenue figure should be determined based upon the arm's length principle. And Shabtamal will come on to describing the arm's length principle in the remainder of the session. So we'll turn now to specific inclusions for the revenue threshold. So that will include all of the income which is derived during a tax period. Of course, we have sales of goods or services. That's not a surprise. That would be included in your revenue figure. We also have sale of business assets. So that's sale of plant and machinery. If you sell any equipment, if you scrap materials and you receive money in exchange, that will also be considered towards part of your revenue figure. And this is an important one, exempt income. So Article 22 of the Corporate Tax Law outlines categories of exempt income, and we'll also cover exempt income in today's presentation. But if there are any dividends or any other forms of exempt income which are received, these will also be calculated and considered towards your revenue threshold. So purely the fact that it's exempt, that is only applicable and relevant for determining taxable income. When you're considering whether you fit within the small business relief conditions, that still will be included, that figure will still be added to your revenue figure. It's not removed, it's not excluded. Also, any non-cash receipts. So if there are barter transactions, if you're exchanging goods for goods, the market value of those non-cash receipts will also be included in considering and trying to reach your revenue figure to assess whether you're within the 3 million threshold or not. What does revenue not include? 2 points here. So VAT charged by businesses registered for VAT, and that is remitted or transferred to the FTA, so does not belong to the business. In those situations, that VAT portion will not be included in the revenue figure. and also any loans or advances received. Obviously, as a small business, if you're obtaining a large loan, that will not throw you out of being able to claim small business relief. So that's a summary of small business relief. And now I'll pass to my colleague Shaptama, who will look at qualifying free zone persons. Thank you.
Thank you, Zubair. Now let's move to the next topic, that is qualifying free zone persons. In this section of the presentation, I will briefly discuss the free zone regime in the corporate tax law. There is a very detailed guide on this subject on the FTA website, so I will briefly cover some key concepts and how a qualifying free zone person will calculate their taxable income. At a high level, the corporate tax rules enable free zone persons that meet certain conditions to benefit from 0% corporate tax rate on certain income derived from activities performed in or from within the free zone. So it is necessary to understand what is a free zone for corporate tax purposes. A free zone is a designated and defined geographic area in the UAE. All taxable persons should check with their respective free zone authority to confirm if they operate in or they intend to operate in a free zone or a designated zone for corporate tax purposes. The next term to be aware of is free zone person. A free zone person is a juridical person that's incorporated, established, or otherwise registered in a free zone and includes foreign or UAE juridical persons that have registered branch in a free zone. It includes free zone authorities and also government-controlled entities established in a free zone. This means that natural persons, unincorporated partnerships, and sole establishments are not free zone persons and cannot benefit from free zone corporate tax regime. A free zone person may have a head office in a free zone and a branch outside of a free zone, or the branch is in a free zone and the head office is outside a free zone, which can be in the UAE itself or in another country. The entire juridical person is referred to as the free zone person. However, each of the different operations or presence they have both inside and outside the free zone needs to be identified, as there are different corporate tax rates that apply to each of them. For ease of identifying the different operations, we refer to the operations that a free zone person has within the free zone is referred to as the free zone parent, and the taxable presence outside a free zone is referred to as the domestic permanent establishment or the foreign permanent establishment, as the case may be. Now, the next thing to consider is if you are a qualifying free zone person. A qualifying free zone person is a free zone person that meets all the conditions provided under Article 18 of the CT law, as well as other conditions provided in Cabinet Decision number 100 of 2023 and also Ministerial Decision 265 of 2023. The first condition here is to maintain adequate substance in the free zone or in a designated zone, which is specific in case of distribution activities. This condition basically requires that the core income generating activities of the business are performed in the free zone and that it has adequate staff, assets, and it incurs adequate operating expenditure in the free zone. The next condition is that the free zone person should derive qualifying income. It has not elected to be subject to the standard corporate tax rate under Article 19 of the CT law. It complies with transfer pricing provisions and maintains relevant documentation. It maintains audited financial statements. Now, these conditions I will explain a bit in detail shortly. Now, coming to the last condition here, it's that the qualifying free zone person meets the de minimis requirement. The de minimis requirement allows a qualifying free zone person to earn small or incidental amount of income from excluded activities or other non-qualifying income without being disqualified from the free zone corporate tax regime. As per Ministerial Decision 265 of 2023, the de minimis requirement is met where the relevant non-qualifying revenue of the qualifying free zone person does not exceed the lower of 5 million dirham or 5% of total revenues. I will also go through a small example later in the slides to explain the de minimis concept. Where a free zone person meets all these conditions, they will be treated as qualifying free zone person for the purposes of CT law. So once you have determined that you are a qualifying free zone person, it is important to understand the impact of being a qualifying free zone person, the compliance requirements, and the impact of losing the qualifying free zone person status. First, let's look at the corporate tax rates that apply to qualifying free zone person. As Rida briefly mentioned, a qualifying free zone person is subject to two different corporate tax rates depending on the category of income earned. It's 0% on qualifying income and 9% on its taxable income that is not qualifying income. What is qualifying income and what is non-qualifying income, I will explain that briefly in the next slide. And an important thing to note here is that a qualifying free zone person is not eligible to benefit from the 0% standard corporate tax rate on taxable income up to 375,000 threshold. Now let's look at how to calculate the taxable income for a qualifying free zone person. So taxable income in respect of income that is not qualifying income will be determined as per Article 20 of the Corporate Tax Law, but without the benefit of certain reliefs such as small business relief, qualifying group relief, business restructuring relief, transfer of tax losses, and the tax group regime. Now let's look at when can a qualifying free zone person lose its status as a qualifying free zone person. There are two possible scenarios for this. One, where the qualifying free zone person itself makes an election to be subject to standard corporate tax rates and rules under Article 19 of the Corporate Tax Law. There can be various reasons why a qualifying free zone person would like to make this election. For example, it may want to become a member of a tax group or benefit for any other reliefs. The election will take effect from the beginning of the tax period in which the election is made, and it will apply to that tax period and the subsequent 4 tax periods. The second scenario where a qualifying free zone person can lose its status as a qualifying free zone person is where it fails to meet the conditions that we discussed in the last slide. So where a qualifying free zone person ceases to meet any of the conditions, it loses the qualifying free zone person status from the beginning of that tax period and the subsequent 4 tax periods. Now let's look at the compliance requirements that is on a qualifying free zone person. Of course, a qualifying free zone person has to register for corporate tax and also has to file a tax return. They also have to comply with transfer pricing requirements and transfer pricing documentation. This means that a qualifying free zone person has to ensure that all transactions and arrangements with their related parties and connected persons is at arm's length. They need to maintain appropriate documentation to demonstrate the arm's length nature of the transactions as required under Article 55 of the Corporate Tax Law. Also, where a qualifying free zone person has income that is subject to 9% corporate tax rate, for example, it has income that is attributable to the foreign permanent establishment or the domestic permanent establishment, it should be able to demonstrate how the profits are attributed to its free zone parent to ensure that the free zone parent is remunerated at arm's length based on the functions performed, assets used, and risks assumed by the free zone parent. A qualifying free zone person has to prepare and maintain audited financial statements. This is irrespective of their revenue threshold. As Rida mentioned, normally taxable persons, as per Ministerial Decision 82, taxable persons are required to prepare and maintain audited financial statements where revenue exceeds 50 million. However, this threshold of 50 million does not apply to qualifying free zone persons. Now let's look at what is qualifying income. So qualifying income includes income from transactions with free zone persons that are beneficial recipients and are not related to excluded activities. Beneficial recipient of a relevant good or service will be someone that does not have the contractual or legal obligation to pass on such service or good to another person. With respect to excluded activities, the list of excluded activities is provided in Ministerial Decision 265 of 2023, and it includes activities such as banking activities, insurance activities. These activities are explained in detail in the Free Zone Guide. The next item on the qualifying income list is income from transactions relating to qualifying activities that are not excluded activities. The list of qualifying activities is also provided in Ministerial Decision 265 of 2023, and it includes activities such as manufacturing of goods, distribution of goods in or from a designated zone, and there are many other activities which are listed as well, and these activities are explained in detail in the Free Zone Guide. The next item is income from ownership or exploitation of qualifying intellectual property. The term qualifying intellectual property is defined in Cabinet Decision 100 of 2023, and the formula to calculate income from ownership or exploitation of qualifying intellectual property is provided in Ministerial Decision 265 of 2023. These are explained in detail in the Free Zone Guide. The last item on the list is any other income, provided the de minimis requirement is met. To recollect, the de minimis requirement requires that the non-qualifying income does not exceed the lower of 5% of total revenue or 5 million dirhams. Now let's look at what is taxable income that is not a qualifying income. So this includes income that's attributable to domestic or permanent establishment, income from immovable property other than commercial property located in a free zone when income arises from a transaction with a free zone person, income from the ownership or exploitation of intellectual property other than qualifying income from qualifying intellectual property. Now let's look at a small example on how the de minimis requirement works. In this example, the taxpayer is established in a designated zone that is recognized for corporate tax purposes. It conducts distribution activity from this designated zone. Let's assume that all the other conditions such as maintaining adequate substance, preparing audited financial statements, complying with transfer pricing requirements, and let's assume that it is not elected to be subject to corporate tax at the standard rates. So in this example, the taxpayer derives two streams of income from distribution of goods to free zone persons and non-free zone persons, and the value of that revenue comes to 8.5 million, and revenue from distribution made to natural persons that comes to 350,000. So the total revenue of the entity comes to 8.85 million, out of which non-qualifying revenue is 350,000. So that brings to the non-qualifying revenue percentage as 3.95%. So because the revenue threshold is, the non-qualifying revenue does not breach the 5% threshold, it does not breach the de minimis requirement, so it will be a qualifying free zone person, and its qualifying income will be subject to 0% corporate tax. However, had the de minimis limit been breached, then the taxable person would fail one of the conditions to be the qualifying free zone person, hence cannot benefit from the free zone regime in the corporate tax law. Let's look at another example of how to determine taxable income in case of a qualifying free zone person. In this case, company A is a free zone person. It has a head office in the mainland and a branch in a free zone. So for corporate tax purposes, the head office will be considered as a domestic permanent establishment, whereas the branch will be considered as the free zone parent. In the example, as you can see, there are directly attributable revenue and operating expenses that can be identified both towards the domestic permanent establishment and towards the free zone parent. However, there's also common expenditure, which is marketing expenditure, that is incurred both for the benefit of the domestic permanent establishment and the free zone parent. These common expenditures have to be allocated using an appropriate and reasonable allocation key. Let's assume that the business here decides that the appropriate allocation key is the revenue itself. So it decides that the common marketing expense can be allocated between the domestic permanent establishment and the free zone parent in the ratio of 2:1 based on the revenue allocated between both of these sections of the free zone person. As you can see, while determining the taxable income, two separate calculations have to be made, one for the domestic permanent establishment and one for the free zone parent. For the domestic permanent establishment, you will consider the revenue, the direct expenses which are attributable to the domestic permanent establishment, the common expenses which are allocated using an allocation key, and the net profit will be subject to a flat rate of 9%. As you can see, the 375,000 threshold is not applied in case of a qualifying free zone person. With respect to the income attributable to the free zone parent, the net profit will be subject to 0% corporate tax. I will now hand over to Anu.
Thank you, Shaptama. Welcome, everyone, and thanks for joining us today. So once you've concluded that there's taxable income to calculate, and that might be because you're a natural person with turnover of more than 1 million dirhams, you might be a free zone person, or you might be a juridical person established in the UAE, how exactly do you determine your taxable income? In the next part of the session, we'll provide an overview of how we do that, and also go into one of the elections that's available to deal with unrealized gains and losses. So there's quite a lot on this slide, but we'll step through it together. Starting from the top, the starting point for determining taxable income is your accounting income. And accounting income is the accounting net profit or loss for a tax period, or in other words, it's your profit or loss before tax per the financial statements which you've either prepared under IFRS or IFRS for small and medium enterprises, as the case might be. The accounting income is then adjusted to determine your taxable income. So what exactly do we need to adjust for? We could have an unrealized gain or loss that we adjust for wherever an election is made. There may be certain categories of exempt income that we need to strip out of accounting income. And this includes dividends and other profit distributions. Typically, these are domestic dividends from other UAE companies. You may have other income and loss from participating interests which fall under the participation exemption. You may have income and expenditure of foreign permanent establishments, which might be stripped out where you make an election, and income derived by a non-resident person from operating aircraft or ships for international transportation. You then look at your reliefs that might be available. And so the two main reliefs are qualifying group relief and business restructuring relief. You then have certain categories of non-deductible expenditure. So it could be expenditure not incurred wholly or exclusively for the purpose of the business, or that have a capital nature, which will be adjusted for. You have disallowed net interest expenditure, which can be carried forward, and other specific non-deductible interest costs. Disallowed entertainment expenditure which is in relation to generating exempt income, and other non-deductible expenditure. You'll then have adjustments for related party transactions or connected persons payments, not at arm's length, so these are your transfer pricing adjustments. Any deductions for incentives or special reliefs, of which there are none available at the moment. And then you may have adjustments specified in a ministerial decision. So the ones we're referring to here are those under Ministerial Decision 120, which are the transitional rules. You may also have the replacement of the effect of the equity method of accounting, gives you an adjustment here. This isn't an exhaustive list, it's just an example, but others might include adjustments related to realized or unrealized gains and losses that are going through other comprehensive income, and also contributions to private pension funds. You then arrive at what we call taxable income before tax loss relief. You then take a deduction for any tax losses that are available to get you to taxable income for the tax period. It is this number that the rates are then applied to. So as my colleagues have already covered, the first 375 dirhams is subject to tax at 0%, and the remainder is subject to tax at 9%. You then arrive at your corporate tax liability, so you're one step away from calculating the actual cash tax payable. And the difference between the cash tax payable and your liability is the availability of any foreign tax credits or withholding tax credits. Now, it's worth saying here that taxable persons that have elected for small business relief are not required to calculate taxable income, so this will not apply to them. For those adopting a cash basis of accounting, the equivalent to accounting income would be the net cash inflow or outflow for that particular tax period. And some of the elections that are available under the accruals basis of accounting would not be available under the cash basis of accounting. So one such election is the realization basis election. So moving on to the realization basis election, what do we actually mean by realized and unrealized gains or losses? So realized gains or losses are actual gains or losses that occur on completion of a transaction. Typically, this is a disposal, and typically what you're getting in return is some consideration. Unrealized gains or losses, on the other hand, relate to a notional change in the value of an asset or liability without an actual realization event occurring. So without an actual disposal or transfer or settlement. And you get unrealized gains or losses where you adopt the accruals basis of accounting. So what is the election? What does the election allow you to do? So a taxable person following the accrual basis of accounting can elect to include gains and losses on a realization basis when calculating taxable income in relation to either all of its assets and liabilities that are subject to fair value or impairment accounting, or all of its assets and liabilities held on capital account. Now, banks and insurance providers that are taxable persons are those that have to apply this election only to assets and liabilities held on capital account. The other point that's just worth noting is that provisions for expenses are not covered under the realization basis election. And then the other point is that, as my colleague mentioned earlier, qualifying free zone persons are actually eligible to elect for the realization basis election. The election for realization basis has to be made in the first tax period at the time of submitting the first tax return. The election is irrevocable except under exceptional circumstances, and this is pursuant to the approval of the FTA. Now, in summary, the effect of the realization basis election is to tax at the point where you actually receive some consideration or on realization. In most cases, a realization event will actually be the disposal of an asset or the settlement of a liability, where consideration or money has actually been received such that you can pay the tax at that point. We'll demonstrate this through a quick example. So we have Company Z who acquires a building from a third party for 800,000 dirhams at the end of a tax period and measures it at fair value going forward. Now in tax period 2, Company Z's fair values the building to 960,000 dirhams. So there's a change in value, or a notional change in value here, of 160,000 dirhams that's reflected in its accounting income. And it represents an unrealized gain because Company Z hasn't actually disposed of the building at that point. So Company Z now has two options. It doesn't need to enter into the realization basis selection, in which case the 160,000 notional change in value is subject to tax, or it can enter into a realization basis election. The effect of this is to exclude the fair value gain of 160,000 in that particular tax period. Now, the fair value gain isn't just ignored. The fair value gain will be taken into account on actual disposal of the building, so when there's a realization event. And this comes back to the point that there's effectively a timing difference here between the tax, the fair value gain and the actual tax arising. So specifically, any adjustments that have been made to exclude fair value gains will be brought back into account on the actual disposal of the building. So in the case of Company Z, when the property is ultimately disposed of, the 160,000 that was previously excluded will be taken back into account. And depending on what assets and liabilities a particular taxpayer has in the year and what fluctuations arise due to market values, you could have a very different tax profile. So your accounting income could look very different to your taxable income in any given year. I'll now pass on to my colleague Suraj, who's going to go into a bit more of the detail around the deductions available and interest limitation rule. Thank you. Thanks.
Good morning, everyone. My name is Suraj Prem Chabra, and I will be taking you through deductible and non-deductible expenditure. So, firstly, we'll go through an overview. We'll go through, in a bit more detail, the general deductibility rule, and then we'll go through the interest limitation rules. This predominantly covers Articles 28 to 33 of the Corporate Tax Law. So, when looking at deductions, first you have to look at your expenses. They must be incurred in the relevant tax period, and there are different rules at play. So we have the general rule. Firstly, this must be incurred wholly and exclusively for the business, and it must not be capital in nature. Therefore, if it's not incurred for business, or it's capital in nature, it's non-deductible. Whilst capital expenditure is non-deductible, the associated depreciation may be deducted, subject to other rules. And if you have expenditure which is incurred for more than one purpose, then a part or proportion of that can be allowed as a deduction, provided it's incurred for the business. And we'll come on to this in a bit more detail. Other types of non-deductibility under the general rule. Firstly, if it's income derived from exempt income. There is an exception to this for interest. Interest which is derived for exempt income is still allowable, but it's subject to the general interest deduction limitation rule. And lastly, we have losses which are not connected or arising out of business. This is also non-deductible. In terms of interest, and all interest is subject to the general interest deduction limitation rule. Provided it funnels through this, it will be deductible. Any amount in excess of the general interest deduction limitation rule, which is 30% of the EBITDA. Again, we'll come on to this and I'll go through an example on this. This will be non-deductible. However, there is a de minimis of 12 million. So this amount that exceeds 30% of the EBITDA, provided it is below 12 million, it will be deductible. There are some exceptions for the general interest deduction limitation rule. So firstly, it doesn't apply to banks and insurance providers. It also does not apply to natural persons conducting business in the UAE. The last type of interest expense that we'll cover today is interest on a loan which is directly or indirectly related, indirectly from a related party for certain transactions. And the main reason for entering into the transaction was to obtain a corporate tax advantage. If it can be shown that you did not try to obtain a corporate tax advantage, this will be deductible. Again, we'll come on to an example on this just to illustrate this further. For entertainment expenditure, if the entertainment expenditure relates to your staff, this will be fully deductible. If it relates to client entertainment expenditure, then only 50% of this is deductible. The remaining 50% is non-deductible. When we refer to client expenditure, this includes meals, accommodation, and transportation. And just to go into a bit more detail, this is any entertainment, amusement, or recreation expenditure to customers, shareholders, suppliers, or other business partners. On the second overview slide, we've got a few more categories. So fines and penalties. If they're incurred as compensation or damages for breach of contract, they're deductible. If it's any other fines or penalties, i.e. for infraction of law, they are non-deductible. Bribes and illicit payments, I think it's fair to say they're not deductible. For dividends and other profit distributions, these are also non-deductible. These are derived after you've determined the profit, after tax, not before the tax. Amounts withdrawn from business. These are non-deductible, and this relates to a natural person who withdraws funds from its own business, or a partner that withdraws it from an unincorporated partnership. Corporate tax is disallowed, so it's non-deductible. And then we have input VAT. If the input VAT is irrecoverable, it is deductible. If it is recoverable, it is non-deductible. And I just want to reiterate this point. If you have input VAT which is recoverable, and you as a taxable person choose not to recover that VAT, it still keeps its own status as recoverable and is non-deductible. It has to be irrecoverable by statute. Tax on income imposed outside the UAE. This is non-deductible, but you may be able to claim a foreign tax credit on this, and we'll talk about this later on. In terms of employer private pension contributions, if these are paid in the tax period, and it's up to 15% of the employee's total remuneration. It's deductible. When we refer to the remuneration of the employees, it's important to note here that this must be at arm's length. And if the contributions are not paid in the tax period, or it's in excess of the 15% of the total remuneration, this will be non-deductible. The last bit of the slide here just reconfirms what my colleague Zubair was talking about with small business relief. If you claim small business relief, you are deemed to have zero taxable income. On that basis, no deductions are available because you've already got taxable income at zero. So going into a bit more detail on the general deductibility rule. Now, you may incur expenditure for more than one purpose. So what do we do here? Firstly, if it's identifiable, so you can identify a part or proportion of the expenditure, and that part is wholly and exclusively for the business, then it will be deductible. If it's a bit trickier than that, then you need to look at the appropriate proportion, and if you can find that appropriate proportion, then that is deductible as well. This may not be easy, but you need to determine a fair and reasonable basis. And without determining a fair and reasonable basis, it will be non-deductible. There's no specific way to determine a fair and reasonable. It will depend on the circumstances and facts of each case. And you may want to use something like an allocation key. In terms of capital expenditure, when we refer to capital expenditure, this is something that creates an enduring benefit. This differs from revenue expenditure, which supports the day-to-day operations of the business. And as we stated on the previous slide, capital expenditure is non-deductible when determining your taxable income. There are a couple of exceptions to this, so we'll quickly go into these. Firstly, the depreciation of the cost of the capital asset is allowable, subject to certain rules. There is also an allowance for low-value capital items, which are directly expensed in the income statement, because this is in accordance with the relevant accounting standard. If the accounting standard does not permit this, any low-value capital items are non-deductible. So let's go through an example on this. Here, we have a natural person. They're in the UAE and they provide advisory services. They do this to various UAE-based companies, and the person earns 4 million dirhams for these services, and this was within the Gregorian calendar year, January to December. Because the earnings are above 3 million, this person cannot claim small business relief, regardless of any expenditure it's incurred. And this person has managed to obtain a loan. The loan was used to purchase an apartment and also an office. The apartment in which they live in, the office in which they work from. Here, the natural person will not be able to deduct the interest expense which relates to the purchase of the apartment, but they will be able to be allowed the deductions, the interest expense relating to the loan for the new office. And here we're using a basis of determining the proportion of the loan to fund the office purchase, and that office purchase is wholly and exclusively for the business. So we'll move on now to a case study. Here we have a company and its accounting income is 12.5 million. When we say accounting income, this is the net profit situation. So within this, the following expenditure has already been incurred, and we're now going to look at this for the adjustments for corporate tax purposes. Firstly, we have items purchased for a subsidiary of 700,000. And this amount that was for the items that were purchased for the subsidiary, it was not reimbursed back to the company. We have employee costs of 2 million, and this was shared with a subsidiary. It was determined that 30% of the employee cost was for the subsidiary, which was not recharged back. In terms of entertainment expenses, there were 1.6 million dirhams incurred. This is broken down into 900,000 for the entertainment of company employees, 500,000 for the entertainment of business partners, and 200,000 for the entertainment of shareholders' families. We have a donation of 1.2 million in the accounts. 500,000 relates to payments to qualifying public benefit entities, and the remaining 700,000 to other persons. We have fines and penalties of 20,000. These relate to speeding fines, and it was found out that these were for the company cars. We have 2 million. This relates to inappropriately seeking to influence a customer's employee, and this was to try and obtain and be rewarded with a contract for the company. This was deemed to be a bribe. And then lastly, we have 3 million of a private pension fund contribution. This was less than the 15% of the employee's total remuneration. And of this, 2 million was paid in the year, 1 million was not. So let's look at these quickly. We start off with the accounting income, which includes all the expenditure, and we need to make the following adjustments. Firstly, items purchased for the subsidiary. It was not for the purpose of the taxable person's business, therefore it must be added back. For the shared employee costs, it was determined that 30% of the 2 million, which is 600,000, related to the subsidiary's business, and it was not reimbursed, therefore 600,000 must be added back. In terms of entertainment expenditure, 900,000 was for company employees. This is fully deductible. No adjustment is needed there. 500,000 was to business partners, of which you're allowed 50% as allowable expenditure. And the last 200,000 was to shareholders' families, and this was not for the purpose of the business, so it's disallowed. This means that 200 from the shareholders' families expenditure or entertainment expenditure and 50% of the 500,000 being 250,000 added together equates to the 450,000 that you can see on the screen. Donations and gifts, 500,000 was to qualifying public benefit entities, which is allowable. The remaining 700,000 was to other persons that were not qualifying public benefit entities, so is added back. The fines and penalties, even though it was to accompany cars, because they're infractions of the law and not a breach of contract, that 20,000 must be added back. Bribes are not allowable. The 2 million gets added back. And in terms of the pension fund contribution, 1 million of this was not paid in the year, as stipulated in the law, so therefore must be added back. This generates a taxable income of 17.97 million. We'll now come over to the general interest deduction limitation rule. Now, the CT law provides for a general interest deduction limitation rule, and the purpose for this is because we want to align interest deductions for CT purposes to profitability. And we'll come on to the mechanism now. Firstly, we need to determine what is your net interest expenditure. And this is the deductible interest, which is the difference between your interest expenditure, which is incurred, and your interest income, which is derived during a tax period. And the interest expenditure here includes any carried forward net interest expenditure. Once you arrive at this figure, you need to determine whether it's within the limit. So what is actually deductible? Is the greater of 30% of adjusted EBITDA or 12 million? Here, the 12 million is a de minimis. So if the amount of net interest expenditure is 12 million or below, you don't need to do the calculation, it's fully deductible. If it exceeds the 12 million, then you must look at what your adjusted EBITDA is. Now, I'll break this down. Firstly, EBITDA. This is your earnings before interest, tax, depreciation, and amortization. It's a concept known to quite a few in accounting. And here we use the word adjusted EBITDA. And the reason we say this is because it's adjusted for using tax figures rather than accounting figures. And then the amount that's allowable is 30% of this. And we will come on to an example. There are a few exemptions from this deduction limitation rule. So firstly, banks and insurance providers, they work with interest every day. We don't want to limit these as it could affect them considerably. Natural persons who actually carry on a business in the UAE, also not subject to this rule. You have resident persons, as described by my colleague Rida, but if they have any net interest expenditure which relates to qualifying infrastructure projects, this will not be included within the rule. And the last one are financing arrangements which were agreed prior to the 9th of December 2022. So I'll go through the calculation of being able to obtain your net interest expenditure. Firstly, you'll look at your net interest expenditure from your financial statements, which is your interest expenditure less your interest income. You will add back any items that are not included as interest for accounting purposes, but they are treated as interest expenditure for CT purposes. You will deduct any items not included as interest for accounting purposes, but are treated as interest income for CT purposes. You'll then remove any interest expenditure that is disallowed under any of the provisions of the corporate tax law. This will include any amounts that are under the arm's length principle and the specific interest deduction limitation rule. I'll come on to the specific interest deduction limitation rule, but I did touch upon it when it's in relation to transactions with related parties to obtain a corporate tax benefit. You'll then deduct any net interest expenditure which relates to grandfathered debts. This is any loans entered into prior to the 9th December 2022, and any net interest expenditure relating to qualifying infrastructure projects. This leaves you with a subtotal, which is your net interest expenditure for the relevant tax period, but it's an important distinction because this is before any carried forward net interest expenditure has been brought forward. And you'll need this for the adjusted EBITDA calculation. But once you get to this subtotal, you must add on any carried forward net interest expenditure from the previous 10 tax periods. This will allow us to arrive at the net interest expenditure for the relevant tax period. This is the figure that we're going to determine whether it needs to be limited or not. Going through the calculation of adjusted EBITDA, we start off with the accounting income and loss as per your financial statements. You will make any adjustments as per Article 20, which is the general termination of taxable income, but you will not adjust for two provisions. You will not adjust for the general interest deduction limitation rule, because that is what we're trying to determine right now, and we will also not adjust for tax loss provisions. You must add back your depreciation and amortization. You must then add back any net interest expenditure for the relevant tax period, before any carry forward amounts. So this is the subtotal that I described on the previous screen. You must add back any net interest expenditure relating to grandfathered debt instruments. And lastly, any net interest expenditure relating to qualifying infrastructure projects. Once you arrive at your adjusted EBITDA figure, you then multiply this by 30% to determine whether you must make any of it is limited. Now the specific interest deduction limitation rule. So we touched upon this earlier, but we'll just go into a bit more detail. So you are not allowed to have a deduction for any interest expenditure which is incurred on a loan obtained directly or indirectly from a related party, where the following transactions with the related parties are: dividend or profit distribution, redemption, repurchase, reduction or return of share capital, capital contribution, or an acquisition of an ownership interest. Now, there may be business reasons for doing this. And so the idea here isn't just to limit it just because of this. This will only be limited where you entered into the transaction to gain a corporate tax advantage. So if we can identify, or you guys can showcase that this was not entered into to gain a corporate tax advantage, then this specific interest deduction limitation rule will not apply. Now, this is a very subjective test. So there is a provision in the law which allows a more objective test. And the objective test is, for the related party that receives the interest income, if that interest income is subject to corporate tax or a similar tax at a rate of at least 9%, it will be deemed that there is no corporate tax advantage. And therefore, this specific interest deduction limitation rule will not apply. So moving on to this case study now, we're looking at interest expenditure. So we have a company again, and as part of its accounting income, it has 32 million of interest income. In its accounts, it also has interest expenditure, which relates to the following. Firstly, there is a loan of 10 million dirhams, which was used for the acquisition of a participating interest. Number two, there are grandfathered debts of 2 million, and these were loans entered into in April 2022, which, as I discussed before, is prior to the 9th of December 2022. We have loan number 2 of 30 million, and this is a Eurobank loan for general funding. Interest relating to foreign exchange losses of 2.5 million relating to loan number 2. We have trade payables, which are amounts owed to creditors of 22.5 million. We have guarantee fees of 1 million, which relates to the performance of commercial contracts. And we have loan number 3. Loan number 3 has interest deductions relating to 28 million, and this is from a foreign subsidiary, and it was used to pay a dividend to a UAE resident holding company. Now, that interest income was not subject to corporate tax or a similar foreign tax in the hands of that foreign subsidiary. And upon looking at this further, it was deemed that there was a corporate tax advantage. One of the main purposes was to get that corporate tax advantage. So here we have a total of 96 million worth of interest expenditure in the financial accounts. So now we must look to see what adjustments to make. Firstly, we need to look at the net interest expenditure. So of all of the interest amounts that we saw on the previous screen, the only 2 adjustments we need to make are for grandfathered debt. This can be excluded because it was entered into before the 9th of December 2022. Now, when we say they're excluded from net interest expenditure, but they are still within your accounting income. So it is fully deductible. It's just for the purposes of determining the limitation, it won't be subject to the limitation. Loan number 3, however, we said the main purpose was to gain a corporate tax advantage. So this is fully disallowed under the limitation rule. It's taken away from net interest expenditure, and it's also will be taken away under a different provision in determining your taxable income. After making these adjustments, you're left with an interest expenditure of 66 million. We said on the previous slide that the interest income was 32 million, so the net interest expenditure is therefore 34 million. So taking into effect the net interest expenditure of 34 million, we are told here that the adjusted EBITDA is 67.5 million. And if we times this adjusted EBITDA of 67.5 million by the 30%, we arrive at 20.25 million dirhams. This exceeds the de minimis. So what this means is the taxable person is allowed to deduct up to 20.25 million instead of the 12 million. So when we try and work this out, we have the net interest expenditure of 34 million. We allow 20.25 million, and the disallowed net interest expenditure will be 13.75 million. This amount, even though it's disallowed, can be carried forward up to 10 years. Thank you very much, and I'll pass back over to Rida.
Thank you so much, Siraj, and thanks to our expert for the valuable information. Ladies and gentlemen, before inviting you all to take a short break, I would like to clarify that the authority has allocated an information desk in the main hall where you can contact them, and they'll be more than willing to answer your questions. So we will see you back in 30 minutes. Ladies and gentlemen, we hope you had a refreshing break. We now move on to the second part of our workshop for today. Please welcome once again our experts to continue the session.
Welcome back, everyone. And after the extensive coffee break, I think we can have also a very detailed session. And in this session, we'll start with the details on the exempt income. We will talk mainly about the participation exemption and also the foreign permanent establishment exemption. So mainly Articles 22 and 23 of the corporate tax law, and also Article 24 of the corporate tax law dealing with the foreign PE exemption. So if you look at the provision on exempt income under the corporate tax law, you will see that dividends and profit distribution received from a UAE company, that is a resident company, they are exempt without the need to meet any condition, except the fact that the distributing entity needs to be a resident person. Dividend and profit distribution received from a foreign juridical person. So if you have a foreign subsidiary and you receive dividends from that subsidiary or realize capital gains from that subsidiary, you need to meet the participation exemption condition in order for those dividends to be exempt from corporate tax. Basically, the income exemption rules also, it does cover foreign permanent establishment income, and this is subject to meeting specific conditions, and is also subject to election. So you need to elect for that exemption when filing your tax return, and we provide some elements on this exemption. And finally, we have also, for the sake of comprehensiveness, we added that one. So income derived by non-resident person from operating aircrafts or ships in international transportation. This income also is exempt from tax under Article 25 of the Corporate Tax Law, subject to reciprocity in terms of treatment. I think it is good to summarize the treatment of dividends and capital gains received by a resident company, UAE Co, from another resident company, Participation Co, and we refer to that as a domestic scenario. So if you have a dividend that is paid by Participation Co to UAE Co, the dividends is exempt without the need to meet any condition except the fact that Participation Co needs to be a resident person for corporate tax purposes. And with respect to capital gains, if you have UAE Co that is a resident person, UAE Co transfer the share capital of Participation Co. The capital gain on the transfer or on disposal of the interest in Participation Co, it will be exempt if the participation exemption requirements are met. So even in the domestic scenario with respect to capital gains on the disposal of interest in a participating interest, the participation exemption requirement, they need to be met. For dividends, the requirement, the participation exemption does not apply. The only condition is that you get the dividend from a resident person that is a taxable person. For capital gains, the participation or the requirement under Article 23(2) of the Corporate Tax Law, they need to be met in order to get the exemption on the capital gains from the disposal of the interest in Participation Co. This is a domestic scenario, which means a scenario where the paying entity and the recipient entity are both resident in the UAE. What about a cross-border scenario, which means that the parent company that is resident in the UAE and the entity paying the dividends or the entity, the ownership interests of which are being disposed of. In that case, whether it is for dividends or for capital gains on the disposal of the interest in Participation Co, the participation exemption requirement, they need to be met. I think it's very important that we clarify these points. And again, as I mentioned earlier, there was an extensive guide on participation exemption that was published. And of course, the ministerial decision on the participation exemption has been updated. A new ministerial decision was released a few months ago. And we will talk also about the changes, the core changes or the main changes that were introduced by the new ministerial decision on participation exemption and foreign PE exemption. So what are the key requirements for the participation exemption? So basically, the first requirement is that the UAE taxable person should have 5% or higher in terms of ownership interest in the participating interest. The second requirement is that the ownership interest, they should be held, or there should be an intention to hold the ownership interest for an interrupted period of 12 months. The third requirement is that the participation interest, so the subsidiary or the entity that is paying a dividend to you as a taxable person, it should be subject to corporate tax or to a similar tax at a rate of 9% or more. You should also, as a taxable person, have access to 5% at least of the profit and liquidation proceeds of the participation interest. And then number 5, this is an important condition, it's the asset test and it's specified under Article 23 2D of the corporate tax law, and under this condition, 50% or less of the assets of the participation, they should consist of non-qualifying ownership interest. So not more than 50% of the assets of the participation interest, which is a subsidiary, not more than 50% should consist of non-qualifying ownership interest if they are held directly by the taxable person. And this is, we will talk about it later on, the assets test. It's a sort of an anti-avoidance rule. Now, there is a flexibility in the legislation whereby if you don't have 5% or higher of the ownership interest, or if your interest ownership don't allow you to access 5% or more of the profit or liquidation proceeds in the subsidiary, or as we refer to the participating interest, but you have a historical acquisition cost of ownership of 4 million or higher, then in that case, the condition number 1 and 4, they will be considered to be met. And then if you meet the other requirement, in addition to the historical acquisition cost of 4 million, you will be considered to meet the condition of the participation exemption. Acquisition cost of more than 4 million or more, condition number 1 and 4, they will be deemed to be met. And then in order to get the participation exemption, you need still to meet the other condition, 2, 3, and 5. What are the conditions in general to avail the participation exemption? If we get into the conditions, basically the participating interest in a participation, it means 5% or higher in terms of ownership interest in a juridical person where the interest is held or intended to be held for an interrupted period of at least 12 months, subject to the following condition. So the subsidiaries would be subject to corporate tax or an equivalent foreign corporate tax at its statutory rate or an effective tax rate of 9% or more. Why we are saying an effective tax rate of 9% or more? Because also in the ministerial decision 116 and 302, even if your statutory rate in the foreign jurisdiction is lower than 9%, you will be able to meet the subject to tax requirement if your effective tax rate is equal to or higher than 9%. So if your subsidiary based in the jurisdiction where, for example, the nominal tax rate is 7%, the statutory tax rate is 7% or 5%, but then the CT liability on the accounting income in that country is equal to 9% or more, then in that case, despite the fact that your statutory rate is less than 9%, you will be deemed to meet the subject to tax requirement. The ownership interest in the participation entitles the holder to receive at least 5% of the profits or liquidation proceeds. And then the asset test, so basically, if the participation is a related party of the taxable person, then not more than 50% of the direct and indirect assets of the participation must consist of ownership interests which would not qualify for the participation exemption if they have been held directly by the taxable person. And this condition, so basically the asset test, as I stated, which is provided under Article 23 2D of the corporate tax law, for tax period commencing from 1st of January 2024, it will apply only to related parties, only when the participation is a related party. And for tax period commencing prior to 1st of January 2025, the condition applies irrespective of whether the participation is a related party or not. And we will have an example on that one. This is one of the main changes that was introduced under the new ministerial decision 302 on the participation exemption. So basically, the asset test specified in Article 23(2)(d) is applicable only when the subsidiary or the participating interest is a related party. And this will apply for tax period commencing on or after 1st of January 2025. For the tax period commencing before 1st of January 2025, the asset test will apply irrespective of whether your subsidiary or participating interest is a taxable person or not. And I think we talked about the aggregated cost of ownership interest. Regarding the aggregation of ownership interest, it is extremely relevant to highlight that if you, as a parent company, with another entity that is a member of a qualifying group, so basically if parent co and sub co satisfy the condition to be member of a qualifying group as stated in the corporate tax law, then in that situation, for the sake of determining the 5% ownership interest and also the minimum historical acquisition cost, you can aggregate the ownership interest. So basically here we have a situation where parent co and sub co are both resident companies in the UAE. Parent co owns 4% of participation co, which is a company resident in a foreign country. Sub co owns 3% of the capital of participation co. And then in that case, on a standalone basis, neither parent co nor sub co will be able to meet the 5%. Because these two entities are part of the same qualifying group, we will be able to aggregate the ownership interest and also aggregate the historical acquisition cost in order to test whether the 5% is met and also the 4 million acquisition cost, historical acquisition cost is met. So this is also its flexibility that is provided in the corporate tax law. The ownership interest, in order to qualify for the participation exemption, the ministerial decision on the participation exemption specified that these ownership interests, they should be classified as equity interests under the relevant accounting standards that is applicable by the parent company. So basically, either IFRS or IFRS for small and medium enterprises as applicable for the taxable person. If we look at the holding period test, and I think it's good to take an example because the example reflects the provision that is also highlighted in the ministerial decision. And the provision is about the situation where the ownership period is not met at a certain stage. So basically, what will happen in that case? If you have the intention to hold the participation for 12 months, but you transfer, it happens that you need cash or for other business purposes, you need to transfer the participation before the 12 months. And we will see how the tax treatment, what is the tax treatment in that situation. So if we have an acquisition of a participation on 1st of December 2024, the dividends are declared and paid on 15 December 2024. In the tax return for the tax period ending 31st December 2024, so basically filed on 2nd September 2025, before the deadline, which is end of September 2025, the dividend is treated as tax exempt on the basis that parent co, the taxable person in the UAE, intends to hold the participation interest for the future 12 months period and for more than 12 months. So they intend to meet the requirement. Subsequently, all of the participation is sold on 15 October 2025. What will happen in that situation? The exemption is no longer available, and the dividends in that case that benefited from the exemption with respect to the tax period 2024, so January to December 2024, it needs to be included as a taxable income in the tax return for the tax period ending 31st December 2025. And basically, the dividends, it needs to be included as a taxable income in the period in respect of which the condition was not met, or the period in which the condition was not met, the holding period of 12 months. So basically, this needs to be included in the tax as a taxable income for the tax period from January to December 2025 to be filed by 30 September 2026. So basically, there is no VD that is required, and you can recapture this, the fact that you didn't meet the condition in the tax period during which the condition of the holding period was not met. What is the type of income that is eligible for the exemption under the participation exemption rule? So this is specified in Article 23(5) of the corporate tax law. So basically, we have income and losses from a participating interest which are not taxable and deductible, basically dividends and other profit distribution, capital gains and losses from the disposal of sale of these ownership interests, foreign exchange gains and losses, and impairment gains and losses on those ownership interests. As an exception to this rule, losses that are realized on the liquidation of a participating interest, they are not exempt, but they are also deductible from the taxable income. And this is an exception to the previous rules. So basically, when we say that income is exempt, it means that the income is not taxable. But also when we say the losses are exempt, it means that the losses, they are not deductible, just for the sake of clarity. There are certain instances, so in addition to the requirement that you find in Article 23(2) of the corporate tax law, there are other requirements in the following paragraph of Article 23. And in the following situation, the income and losses from participation interest, they are taxable and they don't benefit from the participation exemption. So basically, where a participation has claimed a deduction for dividends or other profit distribution. So basically, you get a dividend from your subsidiary, you meet all the conditions, so in principle, this dividend is exempt under the participation exemption rule. However, in the foreign jurisdiction, this dividend is deductible from the taxable base of the subsidiary, of your subsidiary that paid the dividend. In that case, in order to avoid to having a double benefit, so a deduction from one side and an exemption from the other side, this rule is available in order to avoid benefiting from deduction exemption. The other bullet points also, they reflect the same idea. The idea here is to avoid benefiting from a double advantage. So where the taxable person has recognized a deductible impairment loss in respect of the participating interest prior to that participating interest meeting the condition of the participation exemption, also in that case, the income that you get from the participation exemption will not benefit from Article 23. The same for the third bullet point. The taxable person or related party has recognized a deductible impairment loss in respect of a loan that is receivable from a juridical person that is a participating interest. All these 3 points, the purpose of them is to avoid having a double benefit so that you deduct a loss, or you deduct the payment in one jurisdiction, and then you benefit from the exemption, or that you deduct an impairment loss on the participation itself or on a loan, and then you benefit from the participation exemption. Let's look at the following example on the types of income that are eligible for the participation exemption. So if we take company A, which is incorporated and resident in the UAE, it holds a 20% ownership interest in company B, which is a foreign entity. Company A receives dividends and interest income on a loan provided to company B, in addition to realizing a capital gains from the sale of a small number of shares. So basically here, company A will get dividends, will get capital gains, and will get interest income. What is eligible for the participation exemption is only the dividends and the capital gains from the partial disposal of the shares in company B. The interest income is not eligible for the participation exemption based on Article 23 of the corporate tax law. So basically, long story short, not all the types of income from a participation interest are eligible for the participation exemption. Only the specific types of income that are mentioned under Article 23(5) of the corporate tax law, and that I mentioned in the previous slides. So dividends and other distributions, capital gains, impairment loss or gains, and also foreign exchange gains and losses. What about now the asset test? So basically, if we look at the following example, we have company A, which is resident in the UAE. It owns 10% of company B, which is based in a foreign jurisdiction. And company B owns also a certain number of subsidiaries companies, directly or indirectly. So if you look at the assets of company B, the qualifying ownership interest, we have 20,000. Non-qualifying ownership interest, we have 40,000. And we have other assets for 40,000. And here, when we talk about qualifying and non-qualifying, it means qualifying for the participation exemption requirement. The asset test, it needs to be checked at the level of company B, as if these assets, so the ownership in this subsidiary, was held directly by company A, which is a taxable person. So the percentage of non-qualifying ownership interest is 40,000, which is 40% over the total of basically of 100,000 of the assets. So basically here, as company A holds 10% of the share of company B, they are not considered as related parties. And because we are in a period commencing before 1st of January 2025, the asset test needs to be met irrespective of whether company A and company B, which is a participating interest, are related parties or not. So the asset test, as you can see here, will still need to be tested irrespective of whether company A and B are related party or not, considering this pertains to a tax period commencing before 1st of January 2025. And then in that case, less than half of the company B total direct and indirect assets consist of ownership interests that do not qualify for the participation exemption, and then the asset test is considered to be met. If we look after 1st of January 2025, based on the new ministerial decision on participation exemption, so if we look for a tax period commencing on or after 1st of January 2025, because for this period starting from 1st of January 2025 onwards, the asset test is applicable only between related parties. Because company A's hold less than 50% of the share of company B, they are not considered as a related party, then the asset test will not apply. An example on the acquisition cost, the historical acquisition cost, we have Company A incorporated and resident in the UAE. It holds a 4% ownership interest in Company B. The ownership is less than 5%, and therefore the minimum ownership test is not met on a standalone basis. Company A is entitled to 4% of the available profit for distribution and liquidation proceeds. However, the cost of acquisition was 5 million. The cost of the historical acquisition cost of Company B by Company A was 5 million. Company A receives dividends and interest income on a loan provided to Company B during the tax period ended 31st December 2024. In that case, if all the other conditions are met, because we have a minimum historical acquisition cost that is equal to or higher than 4 million, so here we have 5 million, the participation exemption will be applicable, and the minimum acquisition cost, as stated in one of the previous slides, it will replace these two requirements. So the ownership interest of 5% and the entitlement or access to profit or liquidation proceeds of at least 5%. So basically, this is a summary of the previous example. So the dividends will be considered to be exempt because we met the participation exemption, and the interest income, as we stated, the interest income that is received from a participating interest is not eligible for the participation exemption. It does not benefit from the participation exemption because only limited items of income or specific types of income are eligible for the participation exemption. What about the exception to the subject to tax test? So if we have income from the following participation that is treated as satisfying the subject to tax test, even if they are not taxed or they are taxed but at a statutory rate or effective tax rate of less than 9%. So if you have a participation, so the principle or the rule, the standard rule is that if you get dividends from a participating interest, or if you have a capital gains from a participating interest in the UAE, you are in the domestic scenario, so UAE entity receiving capital gains, they transfer the ownership interest in participating interest, another company subsidiary in the UAE. So in that case, as we said, the participation exemption requirements, they need to be met. One of the requirements is that the subsidiary, it needs to be subject to tax at the statutory rate of 9%. What if this subsidiary is a qualifying free zone person or an exempt person? Of course, qualifying free zone person, as explained by Shabtama, if it meets the condition to be a qualifying free zone person, it will be eligible for a 0% on its qualifying income. So it is not subject to 9%. The same for an exempt person. If you have ownership interest in an exempt person under Article 4 of the city law, and this exempt person, because of the exemption under the law, it's not subject to the 9%. In that case, Article 23(4), paragraph 4 or clause 4 of the corporate tax law deem the condition, the subject to tax condition, to be met. The same will apply also for the entity that elect for the small business relief, because if you elect for the small business relief, you are deemed not to realize any taxable income, so your tax rate, you will not pay any corporate tax liability. So also the conditions also here will be deemed to be met, the subject to tax condition. Holding companies also, they will be considered to meet the condition if the following requirements are met. The principal objective and activity of the holding company is the acquisition and holding of investment that also meet the condition of participating interest, and the income of the holding company substantially consists of income from participating interest. So those are exceptions that are available in the legislation in terms of how to approach or how to apply the subject to tax test at the level of the participating interest. And again, as I said, if the effective tax rate is, if your nominal tax rate is less than 9%, but your effective tax rate is equal to 9% or more, you can still be considered to meet the subject to tax test as provided in Ministerial Decision 116 of 2023 and 302 of 2024. Now, what about the foreign PE exemption? So basically, the foreign PE exemption is an exemption that is available under Article 24 of the Corporate Tax Law, and it is based on an election. You elect for it when you file your corporate tax return. A foreign PE is a place of business or other form of presence outside the UAE where a resident person that is basically determined that he will have a foreign PE based on the rules available in Article 14 of the Corporate Tax Law. So the foreign PE is determined based on the permanent establishment rules according to the corporate tax law in the UAE. The new ministerial decision on participation exemption and foreign PE exemption established two types of foreign permanent establishment: qualifying foreign permanent establishment and non-qualifying foreign permanent establishment. What is a qualifying foreign permanent establishment? Is a foreign PE that is subject to corporate tax at a tax of a similar character at a rate not less than 9% in the relevant foreign jurisdiction. A non-qualifying PE is simply a foreign permanent establishment that does not meet the subject to tax requirement. The exemption is, the foreign PE exemption applies only to qualifying foreign permanent establishment, and if you elect for this exemption, you need to elect for all the qualifying foreign permanent establishment exemption. You cannot cherry pick, you choose one or two PEs while you have 3 or 4 or 5 qualifying foreign PEs. If you make the election, you need to elect for all the qualifying foreign PE that meet this requirement as per the new ministerial decision on participation exemption. So if you make the election, the resident person may disregard the income and associated expenditure of all of its qualifying foreign permanent establishment while determining its taxable income. And basically, from practical standpoint and in terms of determining the taxable income, where the election is made, the exemption is applied by excluding the aggregate accounting income relating to all the qualifying foreign permanent establishment. There is a very important rule that you need to consider also, is that where the tax losses are incurred by the qualifying foreign permanent establishment are taken into account in previous tax period, those tax losses, they must be fully recaptured before the resident person can elect for the foreign PE exemption in the subsequent tax period. What is the meaning of this rule? So basically, if in tax period 1, you have a foreign permanent establishment, the applicable rate there is, let's say, 10% or 15%. However, this foreign permanent establishment, it has losses. You didn't elect for the foreign PE exemption, and you claim these losses as deductible losses from your UAE taxable base. If this happens, then in the following year, assuming the foreign PE has 100 of profit, then in that case, you are saying, okay, now I have profit, I want to claim the foreign PE exemption. The rule in the ministerial decision will tell you no. We need to recapture the losses that you deducted initially in the first tax period. So you'll not be able to claim this foreign PE exemption on those profits because of 100, because you deducted losses and you incurred losses in the first tax period. So again, the idea is to avoid having a double benefit. Tax, never forget, it follows you always. Foreign PE exemption, let's take an example. So Company K is incorporated and resident in the UAE. Its accounting income of, it has an accounting income of 15.6 million, includes the following for the various foreign PEs in countries A, B, and C. So the corporate tax rates in countries A, B, and C are 15, 10, and 5%. The accounting income of the foreign PE, 100,000, 2.55 million in country B, and in country C, 3.7 million. The associated expenses or expenditure of the foreign PE are 200,000 in country A, 3.4 million in country B, and 1.75 million in country C. The net accounting profit or loss is, in country A, we have a profit of 500,000. In country B, we have a loss of 0.85 million. And in country C, we have a profit of 1.95 million. If we look at the subject to tax analysis, basically the foreign permanent establishment in country A and B, they are subject to tax of a similar character to corporate tax at a rate of more than 9% in their respective countries, and they are considered as qualifying foreign PE. And then we can claim and elect the foreign PE exemption in respect of those foreign PEs. The foreign permanent establishment in country C is subject to tax of a similar character to corporate tax at a rate that is less than 9% and is therefore considered as a non-qualifying foreign permanent establishment, and then we cannot claim the foreign PE exemption for that PE in country C. Let's take another example. So if we have company K making an election for foreign permanent establishment exemption for the relevant tax period, basically the income and associated expenditure derived from the qualifying foreign permanent establishment country A and B will be excluded while determining the taxable income. But here, for the same example, for country C, the foreign PE exemption will not be applicable, and then you have the computation as you can see on the right side of the screen. Thank you very much, and I pass to my colleague Shabtama to talk to you about the transitional relief. Thank you.
Thank you, Rida. I will now speak about transitional relief, which is provided under Article 61 of the Corporate Tax Law, read with Ministerial Decision 120 of 2023. The Corporate Tax Law applies to tax periods commencing on or after 1st June 2023. For corporate tax purposes, a taxable person's opening balance sheet shall be the closing balance sheet as of the last date of the financial year that ends immediately before the first tax period commences. For example, if your first tax period commences on 1st January 2024, the opening balance sheet for corporate tax purposes shall be your closing balance sheet as of 31st of December 2023. Now, what is transitional rules? Transitional rules basically allow taxable persons to exclude gains or losses relating to periods preceding the first tax period. This is allowed only in respect of specific assets, that is immovable property, intangible assets, financial assets or liabilities. And also these are subject to certain conditions. That is, these assets should be owned prior to the first tax period and they should be recorded on an historical cost basis. So where these conditions are met, transitional rules allow to exclude gains when disposing of immovable property and intangible asset, and exclude gains or losses when disposing of financial assets and liabilities. To reiterate, the purpose of transitional rule is to limit gains and in certain scenarios losses to the portion of gain or losses which arises after the start of the first tax period. It's important to note that the transitional rules is available only where the financial statements are prepared on accrual basis of accounting. So if a taxable person is preparing financial statements based on cash basis of accounting, then transitional relief will not be available. It's also important to note that transitional relief is subject to making an election. So taxable persons will need to make this election in their tax return for their first tax period. This election is irrevocable, subject to an approval by FTA under exceptional circumstances. Now let's look at gains on disposal of qualifying immovable property a bit in detail. For this purposes, for purposes of qualifying immovable property, first let's understand what is an immovable property. So immovable property is defined in the CT law and it's defined very broadly. It includes land, building, structure, or any engineering work that's attached to the land permanently. Where this immovable property is held prior to the first tax period and it is held on an historic cost basis, then it will be considered as a qualifying immovable property. And in context of qualifying immovable property, the transition rules allow to exclude a portion of gains on disposal of any qualifying immovable property relating to periods preceding the first tax period. It's important to note that this election is to be made on an asset-by-asset basis. So where a taxable person holds more than one qualifying immovable property, he has the option to make the election for certain assets that he wants, and he has the option that he cannot make. If he wishes, he cannot make the election for certain immovable properties. The CT law and Ministerial Decision 120 allows to calculate excluded gains under two methods. The first method is the valuation method, which is based on the market value at the start of the first tax period. The second method is the time apportionment method, which is based on the time between the asset purchase and the start of the first tax period. Let's look at a simple example. In this case, Company A, which is the taxpayer, holds immovable properties prior to its first tax period, which starts from 1st January 2024. The original cost of the immovable property was 3 million, and as of 31st of December 2023, the market value of the immovable property was 3.4 million. In 2024, Company A has sold the immovable property asset for 4 million. So from accounting perspective, the accounting gain on the sale of asset will be 4 million minus 3 million of cost, that is 1 million. However, upon applying transitional rules, the portion of gain can be reduced. So applying the valuation method, the taxable gain will be calculated, or the taxable gain which can be reduced will be calculated as assuming that the asset is sold at the market value of 3.4 million, because that was the market value as on 31st of December 2023, minus the original cost, which is 3 million. So considering a 0.4 million gain on each of the immovable property assets that's sold, that's the amount that can be reduced from the accounting income to determine the amount of taxable gain. So to simplify, while the accounting income will show an accounting gain of 1 million per each asset, from transitional rule perspective, the gain can be reduced by 0.4 million. Similarly, in case of qualifying intangible assets, the Ministerial Decision 120 allows to reduce portion of gains on disposal of all qualifying intangible assets related to periods preceding the first tax period. It's important to note a difference here, that in context of qualifying intangible asset, the election applies to all intangible assets held prior to the first tax period and held on historic cost basis. Also, only the time apportionment method can be used to calculate the amount of excluded gains, and this is calculated with reference to the number of days the assets were held prior to the first tax period divided by the total number of days owned. The number of days held prior to the first tax period cannot exceed 10 years, except under exceptional circumstances approved by the FTA. Now coming to qualifying financial assets and liabilities. In this context, financial assets and liabilities will be understood as defined according to the accounting standards, which is basically IFRS or IFRS for SMEs. Examples of financial assets will include trade receivables, shares, loan receivables, whereas examples of financial liabilities will include trade payables, loan payables, lease liabilities. Ministerial Decision 120 of 2023 allows to exclude portion of gains or losses on disposal of all qualifying financial assets and liabilities related to periods preceding the first tax period. In this case as well, the election applies to all qualifying financial assets and liabilities. And this election applies to exclude both gains as well as losses. Also, in case of qualifying financial assets and liabilities, only the valuation method can be used to determine the excluded gain or loss. Now let's move to the next topic, that is transfer pricing adjustments. Under the corporate tax law, transactions and arrangements between related parties and connected persons must meet the arm's length standard. What is the arm's length standard? Conceptually, the arm's length standard requires the terms of the transaction and pricing of the arrangement to be consistent with those between independent parties and not influenced by relation between the related parties. So where the price of a transaction with a related party is not at arm's length, then transfer pricing provisions, that is Article 34 of the corporate tax law, requires that the price of the transaction should be adjusted to arm's length. Also, where a primary adjustment has been made, a corresponding adjustment can be made to the taxable income of the other related party. Article 35 of the corporate tax law provides the definition of who are related parties for the purposes of corporate tax law. The definition includes two or more natural persons related within the fourth degree of kinship. A natural person and juridical person will be considered as related parties, where the natural person alone or along with its related parties directly or indirectly control or own 50% or greater ownership interest in the juridical person. Two or more juridical persons can be considered as related parties, where one juridical person, either alone or along with its related parties, directly or indirectly control or own 50% or greater ownership interest in the other juridical person, or any person along with its related parties directly or indirectly control or own 50% or greater ownership interest in two or more juridical persons. A person and its permanent establishment is also considered to be related parties. Partners in an unincorporated partnership are also considered related parties. And trust, founder, settler, or beneficiary of a trust or a foundation, and the trust of the foundation itself are also considered related parties. A very important concept for determining related parties is the concept of control. Article 35(2) of the Corporate Tax Law provides the definition of control. And this includes the ability of one person to influence another person, including having 50% or more of voting rights, 50% or more composition of board of directors, receiving 50% or more of profits, or exercise significant influence over the conduct of the business. Article 36 of the Corporate Tax Law states that payments or benefits provided to a connected person are deductible to the extent they correspond to the market value of service, benefit, or otherwise provided by the connected person and are incurred wholly and exclusively for business purposes. So what is connected person? As per Article 36, a person shall be considered as connected person of a taxable person if that person is a natural person, that is the owner who directly or indirectly has ownership interest in or controls the taxable person. If that person is a director or an officer of the taxable person, if that person is a related party to the owner, director, or officer of the taxable person, or if that person is a partner in the same unincorporated partnership, and any person that is related party of that partner. It's important to note that the requirement does not apply where a taxable person is listed on recognized stock exchange or where the taxable person is subject to regulatory oversight of a UAE competent authority. This example tries to explain the concept of primary adjustment and how corresponding adjustment can be applied in hands of the other related party. As you can see, in this case, there's company A that is a UAE resident entity, and it sells goods to its local related entity that is company X. As per company A, it can sell, it believes that the arm's length markup for the transaction is 6%. However, when the FTA made an assessment of the transfer pricing policy, it believes that the appropriate markup should be 8%. So this is where the primary adjustment will be made by the FTA, and the markup will be increased from 6% to 8%. So in this case, as you can see, the pre-adjustment, the profit of company A was 300,000, whereas post-adjustment, based on an 8% markup, the profit is increased to 400,000. Since a corresponding adjustment is made for company A, the FTA can make since the primary adjustment is made for company A, the FTA can make a corresponding adjustment to the taxable income of company X, that is the related party, by increasing the purchase cost. So in this case, as you can see, pre-adjustment, the cost of goods was 5.3 million, but post-adjustment, post the corresponding adjustment, the purchase cost is increased to 5.4 million, thereby reducing the overall profit by Now let's look at this case study, which tries to explain how transfer pricing can impact foreign PE exemption. In this example, there's company A, which holds direct ownership of 100% in company B. So company A and company B, for the purpose of this example, are related parties. Company A has a foreign branch in country C. For the purpose of this example, let's assume that this branch C, which is in country C, is a qualifying foreign permanent establishment. And in respect of this branch, company A has made the foreign PE election. Now, when we look at the transactions that's entered by branch C has purchased goods from company B, which is a related party of company A, but this purchase has been made or the company B basically sold the goods at nil cost to the branch. So not an arm's length price transaction. However, when we calculate the amount of accounting income that is to be excluded for the purposes of foreign PE exemption, the accounting income has to be adjusted to arm's length price. So if you can see from accounting perspective, the expense of branch C operations prior to any transfer pricing adjustment is 28 million. But this is the purchase cost, or the expenses is basically undervalued by 2 million because it does not include the value of goods that is purchased from company B. So applying the transfer pricing adjustment, the expenditure will be increased by 2 million. That reduces the accounting income by 2 million. So the accounting income after transfer pricing adjustment will be 5 million. And this is 5 million that can be reduced from the accounting income of company A as part of the foreign PE exemption. Hand over to Anu to take this forward.
Thank you, Shaptama. Good afternoon, everyone. So if we remind ourselves of the overview of determination of taxable income, one of the things that we can also make adjustments for are any reliefs that we've entered into. And the two reliefs that we're covering today are qualifying group relief and business restructuring relief. So what's the purpose or the rationale behind making a qualifying group relief election? So the gains and losses on transfers of assets and liabilities within a qualifying group are not considered in determining taxable income, and this is only applicable if an election is made. The general aspects relating to the transfer and the type of assets are now what we're going to cover. So the legal and economic ownership must be conveyed from one person to another, and that's the legal and economic ownership of the asset or the liability. The election applies to assets or liabilities held on capital account and recorded on the balance sheet of the transferor, so it can't be an off-balance sheet transaction. and it does not actually require any consideration to be paid. Now, what conditions are there to be qualifying group members? The first is that they must be juridical persons, so that's resident or non-resident with a PE in the UAE. Either one taxable person has a direct or indirect ownership interest of at least 75% in the other, or a third person, which again can be a resident or non-resident with a PE in the UAE, has direct or indirect ownership interest of at least 75% in each taxable person. So you're either looking at a chain of companies or sister companies here. None of the taxable persons can be an exempt person or a qualifying free zone person. Both taxable persons' financial year end must end on the same date, and both must follow the same accounting standards. Now, there are certain conditions that must be met after the transfer of assets and liabilities. These need to be met such that there's no clawback. So the transfer will be treated as taxable, either be a clawback of the relief if, within 2 years of the transfer, the taxable persons cease to be members of the same qualifying group, so if one of the taxable persons leaves the group, or there's a subsequent transfer of the assets and liabilities outside of the qualifying group within 2 years. Now, it's important to note that where assets or liabilities are transferred to a taxable person as a result of a liquidation or a dissolution or a merger, that's where an entity is basically ceasing to have legal existence, then this relief does not apply. Very similar to the realization basis election, the QGR, as it's commonly known, or the qualifying group relief, is actually a timing benefit. And it's largely, again, to match the realization event outside of the group to when the consideration is actually received for that asset or liability. On eventual disposal of an asset outside of the qualifying group and outside of the 2-year clawback window, the entity disposing of the asset would need to take into account any gains that had not previously been subject to corporate tax because of the relief applying. So let's take a look at a quick example. So we have Company C and Company D, and they're both conducting a manufacturing business and wholly owned by Company A. C and D are incorporated and tax resident in the UAE, and they meet all of the other conditions to be considered as members of a qualifying group. They've not elected to form a tax group under Article 40 of the Corporate Tax Law. That's a very different concept. Company C makes an election for qualifying group relief to apply to the transfer of some machinery to Company D. Now, C transfers, and this is from an accounting perspective. So C transfers the machinery to D, and Company C doesn't request payment. Company D doesn't actually make a payment. At the time of the transfer, the net book value of the machinery was 800,000 dirhams, and its market value was 1.2 million dirhams. Company D, on acquisition of the asset, recognizes it at its market value of 1.2 million. So this is what happens from an accounting perspective. What happens from a tax perspective is, because of qualifying group relief, the transfer is effectively at net book value. So to ensure that there's no gain or no loss, which is what is supposed to be achieved under qualifying group relief, the consideration is deemed to be equal to the net book value of 800,000, and that's what that table is trying to show in the bottom right corner. Now let's take a look at business restructuring relief. How does it work? So it works where the entire business or an independent part of a business is transferred in exchange for shares or other ownership interests, and no gain or no loss then needs to be taken into account in determining taxable income subject to various conditions being met. So it's a restructuring provision. Again, there are certain clawback conditions. So and the conditions are that all shares, ownership interests, business or part of a business being transferred should remain in the transferee company or the qualifying group for at least 2 years. Otherwise, there would be a clawback and the original transfer is treated as taxable. The other condition is that if the recipient receives other consideration in addition to the shares as part of the transfer, the value cannot exceed the lower of the net book value or 10% of the nominal value. Now, what's quite interesting here is that there is an impact on losses. So where there are any unutilized tax losses incurred by the taxable person, so the transferor company where it's transferring a business, say, prior to the tax period in which the transfer completes, all of these unutilized tax losses move to the transferee. If a part of the business or ownership interest is transferred, then only that proportionate part of the losses are transferred. Business restructuring relief, again, is applicable by way of an election that needs to be made in the tax return. Again, there are certain conditions that must apply for business restructuring relief to apply in the first place, and that's that the transfer is undertaken in accordance with and meets all conditions imposed by the applicable non-tax legislation of the UAE. So this might be merger or demerger law that exists in the commercial law framework. The taxable persons must be resident persons or non-resident persons that have a permanent establishment in the UAE. None of the persons can be exempt persons or qualifying free zone persons. The financial year of each of the taxable persons must end on the same date, and they must prepare their financial statements using the same accounting standards. And finally, the transfer must be undertaken for valid commercial or other non-fiscal reasons which reflect economic reality. Again, let's go through a quick example. So the effect of the relief is that the transfer of assets and liabilities for tax purposes should be achieved at net book value. So here we have a company F that's tax resident and incorporated in the UAE, and it sells agricultural machinery. Company Z is a company tax resident and incorporated in the UAE as well, and operates an agricultural machine repair business. During a tax period, F buys Z's business in return for 20% of the shares in Company F. The net book value of Company Z's business at the time of transfer was 2.3 million dirhams. The market value of the shares received by Company Z is 2.7 million, which effectively is equal to the market value of the business that's transferred to F. So Company Z measures its assets and liabilities at fair value and recognizes the assets and liabilities of the transferred business at its market value of 2.7 million dirhams. And again, this is from an accounting perspective. From a tax perspective, the purpose of business restructuring relief is to transfer at net book value. So to ensure that there's no gain or no loss for tax purposes, the consideration must be deemed to be equal to the net book value, which in this case was the 2.3 million dirhams. And again, that's what the calculation is trying to show there on the bottom right corner. So these are the two main reliefs. We then get to a point where we've calculated our taxable income. We might then get some relief for tax losses to the extent that they're available. So what is a tax loss? This is where a taxable person's deductible expenditure exceeds its income. And effectively, they have a negative taxable income, or what we call a tax loss. What is the relief? So tax loss can be used to reduce taxable income in future tax periods, but to a maximum of 75% of the taxable income in each subsequent year. And we'll go through a couple of examples to demonstrate this point. Unutilized tax losses can be carried forward indefinitely, but there are two rules that would restrict this. The first is that if 50% or more of ownership interest in a taxable person is constant from the year when tax losses arise to the year of offset. So basically, if there's a change of control, then the loss utilization may be restricted. Where there is a change in ownership of more than 50%, but the taxable person continues that same or similar business, they may still be able to utilize those tax losses. And again, we'll have a look at a couple of examples to illustrate this. There are some cases where losses may not be eligible for relief, and those are losses incurred before the commencement of corporate tax, because at that point they wouldn't have been known as tax losses, before a person becomes a taxable person, or from assets or activities which generate exempt income. And we've had a look at some of these, which are sort of maybe the cost of transactions or interest costs related to a participating interest. Tax loss relief cannot be claimed for tax periods when small business relief is elected for, and that's because the taxable income is effectively not being subject to tax in that period or subject to tax at 0%. So let's have a look at an example of how tax loss relief and carry forward rules work. So we have a parent company who holds 100% of shares in a subsidiary company, and in year one, the subsidiary company generates a tax loss of 100 million dirhams. In year two, there is a slight change in control of there is a slight change in ownership of subsidiary company, and buyer company owns 30% of subsidiary company. In year two, subsidiary company generates a taxable income of 20 million. So the profile of subsidiary company in year two is that it has initially, before tax loss offset, income of 20 million dirhams. It can then offset its year one tax loss, but only to a maximum of 75% of the taxable income. In this case, that's 15. The balance of taxable income for the year two is 5, and that's the amount that it would then pay tax on. And the amount that can be carried forward is the balance of the 100 million tax loss less the 15 utilized, so it's 85 million that's left to carry forward. Now, the point here is that the whole amount of the loss could potentially be offset without any restriction due to the change of ownership here, because the change in ownership is less than 50%. Now, what are some of the conditions for the transfer of tax losses? Tax losses of a taxable person can be transferred and offset against the taxable income of another taxable person, provided that relevant conditions are met. And those conditions are that both persons are resident persons and juridical persons. Either one taxable person has a direct or indirect ownership interest, or at least 75% in the other, or a third person has direct or indirect ownership interests of at least 75% in each taxable person. And what that's trying to say again is that this could be a chain of companies or it could be sister companies under common ownership. The common ownership must exist throughout the tax period in which the tax loss is incurred to the end of the tax period in which the transferred tax loss is offset. None of the taxable persons can be exempt or qualifying free zone persons. Both must have the same financial year end and apply the same accounting standards. Again, the total tax loss that's transferred cannot exceed 75% of the taxable income of the taxable person that's claiming the tax loss. So here we have a diagram to basically show the types of entities that would be eligible here for the transfer of tax losses. So non-resident subsidiaries, regardless of their ownership, are not able to transfer tax losses. Same goes for qualifying free zone persons and exempt persons. Let's take a look at another case study to look at the transfer of tax losses in a bit more detail. So we have 3 companies, A, B, and C, all incorporated and tax resident in the UAE. They all have a tax period that corresponds to the Gregorian calendar year and prepare their financial statements on accrual basis of accounting using the same accounting standards. So they meet the conditions here. Company A holds 100% direct ownership of Company B, and A and B each hold 50% in Company C. Importantly, they have not applied to form a tax group because that's a very separate set of rules. So the tax profile in 2024 is that Company A has 40 million dirhams of tax losses, Company B has 10 million dirhams, and Company C has 5 million dirhams of taxable profit, or taxable income. Now, how can the loss be offset? Company A can transfer its 2024 tax loss as follows. So it can transfer 7.5 million dirhams to Company B, because That's 75% of company B's taxable income. To company C, it can transfer 3.75 million because that's 75% of company C's taxable income. So we get to a point here where the taxable income of company B and C are both reduced by the amounts of losses that they've claimed from company A. The taxable income is then subject to tax at the relevant rates, and the corporate tax payable is as shown. The tax loss carried forward in company A is the balance after having surrendered losses to company B and C. And that's 28.75 million. Now, in theory, the losses of company A could be carried forward indefinitely. But what if there was a change of more than 50% in the ownership of A and A's business changed? Well, in that case, the losses would not be able to be offset any longer. And this is regardless of any change in the situation in company B and company C. Now over to Zubair to cover foreign tax credits. Thank you.
Thank you, Anu. So I'm going to briefly talk about the foreign tax credit and specifically covered under Article 47 of the corporate tax law and what it means in respect of the taxable income that you'll have to pay. So starting off briefly, what is the foreign tax credit? It's a unilateral relief that exists in the corporate tax law on foreign source income which has been earned overseas and tax has been paid. And that foreign tax credit can be used to offset the corporate tax payable in the UAE. Now, there's a number of conditions and limitations, so we'll go through each of these one by one. The pre-tax foreign source income, so the income that's earned from overseas, must be included in the taxable income in the UAE. If it's not included in the taxable income in the UAE, then foreign tax credit will not be available. It won't be applicable. Also, the amount of the foreign tax credit cannot be more than the corporate tax which is due on the foreign source income. We'll come on to the calculation in just a moment, but it's worth noting that the amount of foreign tax credit which is effectively on that income cannot exceed the corporate tax payable for that same amount of income. And importantly, foreign tax credit has to be used and it's only applicable in that specific year. It cannot be carried backwards, forwards. If it's not used, it is forfeited. So there's no other option to utilize it. It has to be, it's only relevant in the specific, in that same tax period. And the reason I say forfeited, if anything is not used, it is forfeited. There's no refund which is provided. So what are the requirements? The requirements are that the taxable persons must keep all the necessary records for claiming the foreign tax credit, so that's certificates, statements, which effectively show that the payments have been made or the assessments raised from the other tax authority in the overseas jurisdiction. Now we come on to the calculation that I just mentioned. So in order to calculate your foreign tax credit, it's the lower of two figures. First is the simpler of the two, and that's the actual tax that's paid in the foreign jurisdiction. And the second is the amount of corporate tax due on the foreign source income net of related expenses. And that's what I meant in terms of how much would be due in the UAE. So the specific calculation is on the right hand of the screen, and it's X times Y over Z, and X would be the corporate tax due on the total taxable income. So for this specific taxable person, they would look at all of their taxable income, including the foreign source income. You would times that then by the relevant foreign source income that you have and divide that by the total taxable income of the taxable person. So X being the corporate tax due, Y being the relevant foreign source income, and Z being the total taxable income of the taxable person. let's put this and plug some figures in and put this into an example. So the facts of this case are company A has taxable income of 1,736,375 dirhams. Company has a branch in country B, and 500,000 of the taxable income is earned by branch B in country B, effectively foreign source income. And country B, company had paid tax in respect of that foreign source income equivalent to 50,000 dirhams. So effectively a rate of 10%. Now, the facts on this are we're assuming that company A has not made a foreign PE exemption election, and now we'll calculate the foreign tax credit based on this information. So we start off with our net taxable income. So remember, the starting point is effectively after everything that we've discussed today so far, after your reliefs, after when you have your taxable income figure, and that is the starting point for the foreign tax credit calculation. Then we calculate the corporate tax due on the taxable income. So this is looking at the 0% band of 375,000 and the 9% band, and that leaves us with a figure of 122,524 dirhams. And now is when we deduct the foreign tax credit. So it's the lower of two figures. The first is the simpler of the two, the 50,000, which is the amount paid in the foreign jurisdiction. And then we have our calculation that we just talked about with that formula. And so we're plugging in, firstly, the corporate tax due on the total taxable income. We've just worked that out to 122,524 dirhams. We times that by the foreign source income, so the 500,000 that was earned by branch B, and then we divide that by the 1,736,375 dirhams. And that leaves us with the figure of 35,281 dirhams. So the lower of the two is 35,281 dirhams, and that means that would be our foreign tax credit figure. So the corporate tax payable, what does this mean? We have our taxable income of the 1 million figure. We deduct the foreign tax credit, and we're left with 87,243 dirhams. That is our corporate tax payable. Now, one point to note, and I just mentioned in the previous slide, the balance of the unutilized foreign tax credit, it's forfeited. Can't be carried forward, can't be carried back, and because it's not used in this year, the 14,719 dirhams is forfeited. I just want to end with saying that there is a guide on foreign source income, and it's quite detailed. So to understand the calculation better and to see a number of more examples, please have a look at that guide. Thank you very much. I'm now going to pass to Suraj, who's going to talk about compliance.
So far we've talked about determining taxable income. You've determined your taxable income. We now have to look at the compliance side of things. So I'm going to go through the tax return and the payment of tax. So we'll start off with the filing deadline. This is 9 months from the end of the relevant tax period, and this must be done via the Mara Tax portal. So you'll go to your corporate tax element of that portal. There'll be the corporate tax section. There's a filing button, and you will have 9 months to file a return. That doesn't mean you have to wait for 9 months. When your tax period ends, you'll be able to file from then onwards to the end of the 9-month period. Now, there is an initiative that we spoke about earlier, and this initiative is the late registration penalty waiver. So some people may have incurred an administrative penalty for the late submission of a corporate tax registration. Now, this initiative allows this penalty to be waived, provided that you file your tax return within 7 months of your first tax period. I've got a few examples on this on the next slide. The main thing to note here is this is about filing your tax return. You don't have to pay the corporate tax payable in order to get access to this waiver. In terms of the tax return itself, so there's quite a lot of information that will be in the tax return, and it will include some of the following. Firstly, the tax period of the tax return, the name, address, and your tax registration number. These two are both taken from your registration details. It is really important that your registration details are up to date so that when it pulls through the information, it's as accurate as it can be. By the end of the return, you will come to your taxable income for the tax period, so it will help you in identifying what that is, and it also helps in part of the calculation. You'll also see on the right-hand side that it will show you the amount of the any tax loss relief that you've claimed, so this is your carried forward amounts. It will also show you any amount of tax loss that you've transferred from and to other group members. It will also show you the amount of tax credit that's actually claimed, which my colleague Zubair just mentioned about. We will also get the accounting basis of supporting financial statements, and financial statements are the basis for starting your corporate tax journey. So it's important that these are done accurately and provided along with the tax return. Once you've determined your taxable income for the tax period, it will also show you the amount of corporate tax payable for that tax period. And upon submission, I'll give you your date and a receipt of the date of the submission of your tax return. In terms of currency, if you have, for your accounting purposes, used a currency other than UAE dirhams, then this needs to be converted. And the conversion needs to be done in UAE dirhams, and it uses an exchange rate which is set by the Central Bank of the UAE. But there is a priority order. So firstly, you should use a spot rate. This is more done on a transactional basis. If it's a one-off transaction, this would deem to be practical. If there are numerous transactions which are quite hard to follow and it's not practical, you can move over to the average monthly exchange rate. If both of these are not practical, then you must use the average annual exchange rate. Now on to the waiver of the late registration penalty. So I've got 5 examples here, so I'll run through each one. In the first example, you've completed your registration, you received a late registration penalty. You've not yet paid that penalty, but you have submitted your tax return already, and that was within 7 months of your first tax period. You don't need to do anything else. That late registration penalty will be waived. In scenario number 2, it's exactly the same, but you haven't submitted your first tax return. You must ensure that you submit your first tax return within 7 months at the end of the first tax period, and then your penalty will be waived. In scenario number 3, you've completed your registration, you received a late registration penalty, you've paid that late registration penalty, and you have submitted your CT return within 7 months from the end of your first tax period. In this case, your late registration penalty will be waived, but on top of that, because you've already paid it, this will be credited back to your Mara tax account within the corporate tax section. Scenario 4 is similar to number 3, but you haven't submitted your account, so you have paid the you have paid the penalty. To ensure you get the waiver, then submit your tax return within 7 months at the end of your first tax period. It will get credited back to your account, and the penalty will be waived. And then lastly, If you have not yet registered, but you will get a penalty, you can still benefit from this waiver. So please come forward, register, submit your tax return within the first 7 months, and the penalty will be waived. I just want to mention 2 more things. I've said already, this does not rely on the payment of your corporate tax payable. This is purely a waiver from filing your first tax return. Secondly, your first tax period can be shorter or longer in certain circumstances. So just because it's shorter and longer doesn't mean this doesn't apply. You just have to submit 7 months after the end of that first tax period. And lastly, we'll go on to the payment and refund of corporate tax. So the due date for payment is similar to the filing deadline. It must be settled within 9 months from the end of your relevant tax period. And in terms of a refund, a taxable person can make an application to the FTA for a corporate tax refund, and there are 2 circumstances that this can happen. Firstly, if you have a withholding tax credit available to yourself and it exceeds the taxable person's corporate tax payable, you can get a refund. However, the rate of UAE withholding tax at the moment is 0. You cannot get a withholding tax credit that exceeds 0. Therefore, this doesn't apply at the moment. Secondly, if the FTA is satisfied that the taxable person has overpaid corporate tax, and an example of this is you submit your return, you subsequently submit a voluntary disclosure which lowers your taxable income. If the FTA is satisfied, a refund may be permissible. That's it on the compliance. I'll now pass over to Rida. Thank you.